Hello everyone. Today's class we're going to discuss about the revision videos basically. We're going to look into revision videos, this paper one accounting. So we'll start off with the topic BRS. Okay. So when coming to the topic BRS is nothing but bank reconciliation statement. So what do we understand by the term bank reconciliation statement? So basically there'll be a cash book and also there'll be a passbook. Passbook. Okay. And the difference between the cash book and passbook at a given point of time, say end of the month, that is 31 end of the month, end of the year, whatever it is. Okay, that difference is that between the cash book and passbook at a given period of time, you have to see. Okay, those differences to be reconciled. That is called bank reconciliation statement. Okay, so we'll look into the meaning first. So basically, a businessman, any person maintains a record of his transactions with the bank in the bank column of cash flow. The bank column of cash flow will be maintained in the its transactions. The bank maintains a record of its transactions with its claims in the past. The bank will be maintaining the transactions in the passbook. Okay. So transactions recorded in both the books are the same, and therefore on the given date, bank balance as per the cash book and bank balance as per the passbook should be same. Okay, it has to be the same, but there'll be some differences. What are those differences? We'll look. But it is not same due to various reasons. It is not same due to various reasons. Okay. Therefore, we need to put that bank reconciliation statement to reconcile the difference between the two books. Normally, it is prepared at the end of every month. Okay. So, at given point of time, the bank balance and the bank balance as per passbook and the cash book has to be the same. Has to be same, but it won't be same due to various reasons. That is why we are preparing bank reconciliation statement. Okay. Prepared to explain the differences. Basically, bank reconciliation statement is prepared to explain the reasons of differences. What are the reasons? We look into it one by one. Okay. Okay. Reasons for preparing bank reconciliation statement. What are the reasons to be for preparing bank reconciliation statement? Any undue delay in the clearance of check will be shown up by the reconciliation. Say, for example, if you've deposited any check, for clearance, if you deposit, you made payments, okay, through check. So when you make payments through check, in your books it will be recorded. In the books it will be recorded, but in the passbook, in the bank, until the clearance, it won't be recorded, right? So which all is cleared, which all is not cleared. So you'll be getting a statement at the end of the month. At the end of the month. So to know those items, you can prepare the bank account statement is prepared. Okay, that is one of the reasons. Second, if you're committing any errors, say it might be omission, you're just maintaining, you're totally omitting a particular transaction, okay, in the cash book, but it will be reflected in the past. So to reconcile between, to understand if you missed anything, so to reconcile between the cash book and passbook, okay, so that is why the reconciliation is being made. Okay. The reconciliation will bring out any errors that may have been committed either in cash book or in past. Okay. Then coming to this is the second reason. Then coming to third one. What is the third reason? A regular reconciliation discourages the accountant of the firm from embezzlement, just that theft of cash. Okay. Theft. So if at all, if the accountant is taking away any money, we can get to know because both the balances has to match. Okay. So in the reconciliation, we'll get to know. That is the reason we are preparing this BRS. Okay. Fine. Then what are the different types of balances that can be observed in the bank balances and the cash book balance and the passbook balance? Say the cash book balance is favorable. If it is favorable always means debit balance. No. Asset will always have debit balance. It is favorable. If an asset is having credit balance, which means it is unfavorable. That is nothing but bank overdraft. In this case, it will be bank overdraft. Okay. Then cash book overdraft, unfavorable. Overdraft means unfavorable, which will have credit balances. Then passbook balance. passbook balance means in the bank. If it's favorable, that shall have credit balance. For us, we maintain cash. Okay. Here, if the cash is debit, which means it is favorable. If the cash is credit, cash means cash or bank, both, anything. Okay. I'm just using the word cash here. It can be interchangeably used for cash or bank. If the cash book is showing credit balance, which means it's unfavorable. That is nothing but bank overdraft. It will be bank overdraft. Then bank will be maintained, passbook will be maintained here. So the passbook balance, if it is favorable, credit means it is favorable. Same passbook balance, if debit means unfavorable. There's nothing but bank overdraft. Okay, which means bank over. These are the 4 types of balances which you can see. Done. We'll go on to the next topic. We'll quickly go through the topics, okay? Like this is a revision video. Quickly go through the topics. Reasons of differences between cash book and passbook. What are the reasons? What are the main reasons for the differences between cash book and passbook? So initially we discussed on the meaning, right? Then at a given point of time, the balance as per cash book, the balance as per passbook has to be same. Okay, but this won't be same. Why? What are the reasons? What are the differences causing this? There might be timing difference. What is this timing difference? Like we discussed, the check, you're making a payment. So in the cash book, it will be recorded. But if it is not being clear, in the passbook, it won't be recorded. Okay, but there's a timing difference. That is one of the differences. Okay, difference arising due to errors in recording the entries. Okay, difference due to errors. If any errors is made, that also can be, that is one of the reasons for the differences. Okay. Then also one more difference is that, one more reason for the difference is that transaction undertaken by the bank. Sometimes what will happen, bank will give us some interest. It will automatically make some payments, EMI payments. Okay, all of these things, the transaction which is directly undertaken by the bank, which is not recorded in the cash. When you're doing bank reconciliation statement, in that time you'll get to know all of these transactions. That time you'll be making a entry in your cash book as. Okay, these are the 3 reasons of differences. One is the timing difference. Another one is the difference arising due to errors in recording the entries when transaction undertaken by the bank. Okay, fine. Then examples. Yeah, we'll look into the examples online. We have 15 examples. I've listed out all the possible examples here. So we'll just look into one by one. What are the reasons for difference we spoke about, right? So those reasons, in that differences, these are the items which might cause differences. Check deposited but not cleared. This is one of a difference. Okay, check has been deposited. But still it is not cleared by the bank. Check issued but not presented for payment. Check has been issued. In the cash book, check has been issued. Okay, but still it is not presented for payment. Okay, checks deposited but dishonored. Okay. Checks deposited, you deposited the check but dishonored. So you won't get to know until the bank communicates the same. Check has been dishonored. Okay, check issued but dishonored. This also, you have issued the check, but you don't have the funds and it got dishonored. Okay, but then overcasting error. These are the errors. Overcasting error in cash book or passbook and undercasting errors in cash book or passbook. Okay. Overcasting error means you've taken the total balances or the expense balances higher. You've taken higher balances. More balance you've taken. Undercasting means you've taken less balance, lower balance. Okay. Then bank charges, commission, etc. debited by the bank. Okay, this will be recorded in the passbook by the bank, but you wouldn't have recorded it. So during the making the BRS at the end of the month, we'll be recording all of this. Interest credited by the bank, direct payments by the bank. Like I mentioned, no EMI, or you would have given any standing instructions saying that to make these payments. Yeah, and direct collections by the bank. Bank is collecting any particular amount on the instructions. Direct deposit by customers. If any customer is directly depositing any amount into the bank, so you wouldn't know that, right? So at the end of the month, that will be concerned. Then debit balances wrongly taken as credit balances. Again, errors only. And credit balances wrongly taken as debit balances. Either of the ways. Okay. Then bank transactions recorded in cash column of cash book. So generally bank transaction has to be recorded in bank column of cash book, not in the cash column. So when you recorded it, the cash column, it will be understated. Either the expense or the income, the deposit or withdrawal, both will be understated. Okay. Because of which you need to make this notice. Transferred to and from the current account. So these are all the examples which we might see in the questions. Okay. Then coming to cash book rectification, adjusted cash. So what happens here in adjusted cash book? Adjusted cash book is nothing but you've already prepared the cash book. Okay. Then later you understand that there's been a difference. There has been some errors you have made in the cash book. Okay. That rectification is known as cash book rectification. The rectification which you make after you get to know, after closing the cash book for the month. Then during BRS, you get to know that you missed out so many items so that you rectify the cash book, then do the bank reconciliation statement. Okay. Here, two steps you have to do. One is do the cash book rectification. That is nothing but just a cash book, Then do the BRS. In other cases, we do only BRS. But in this case, we do these two steps. In the first step, second step. Just a cash book you do. Then you do the BRS. Just a cash book when you do, you take the adjusted balances. You just take the adjusted balances. Yeah. As per traditional concept, all item of differences between bank balance as per cash book and pass book appears in BRS. But as per practical approach, all those items that cash book has a mistake or discrepancy should be corrected in the cash book itself. And the bank balance as per cash book should be rectified. Yeah. Same thing what we discussed. Items requiring cash book corrections. What are the items that requires cash book corrections? What are the items we might have missed out? 4 items are there. Direct payments or collections made by the bank but not recorded in the cash book. If it's not recorded in the cash book, we'll record it. Then take for BRS. Okay. Which is not recorded in the cash book. Next. Checks deposited or issued but dishonored, and the dishonored entry is not yet passed in the cash book. Entry, whatever the entry is not made in the cash book, we have to make those entries. Okay. So entry is not yet passed, no entries in the cash book. Bank charges, interest, commission, etc. debited by the bank, but not yet recorded in the cash. If it is not yet recorded, we'll have to record in the cash. Mistakes committed in the cash. That's basically errors what we discussed about. No. Now the BRS will show only the items where the pass book has discrepancies. So when you make all of these adjustments in the cash book, so cash book will be the balance. The cash book will be displayed correctly. So now we have to make adjustments only in the pass book. Okay, that is what it says. Now the BRS will show only those items which the pass book has discrepancies. Okay, done. Here in the cash book rectification or adjusted cash book, nothing complicated here. Just that you need to prepare a cash account first, and then you have to prepare a bank reconciliation statement. Okay. Ways of reconciling of cash book and pass book. What are the different ways? The first step. See, sometimes in the question, both cash book balance and the pass book balance will be given. Okay. Either you can start arrive at the pass book balance from cash book, or arrive at cash book balance from pass book. Okay. Either of the balance you can choose. You can choose either cash book balance or pass book balance. Any one of the balance you can choose, and when you start the question and start doing it, you will be arriving at different cash book. That is, if you started with cash, you'll be ending up with pass book balance. If you started with pass book balance, you'll be ending up with cash book balance. Okay, done. Either of the ways you can start the question. Okay, whichever way you start, the answer will be the same. There won't be any change. Okay, this is what you need to know about the topics here. So here the main trick is we need to know whether we need to add or subtract. So that is the main thing. Okay. We'll just go through a small example here. Then we shall take up some example questions. Okay. We'll just go through some example. So what happens here? Say for example, we are starting with cash book. Okay, we are starting with cash book. We are ending with passbook. We have to end with passbook. There is some balance which is given. There is some balance which is given. So here what happens. So for example, say checks has been payment has been made through checks. Payment made through checks. So when you're making payments through checks, what will happen? The cash book will show correct balance only because you made the payment. But in the passbook, still if it is not gone for payment, still it won't be reflected. Okay. So in that case, what will happen? The cash book will be showing higher balances. Okay. So we'll have to make adjustments accordingly. How do we make these adjustments? Say for example, you're starting in cash. Say for example, you're starting with cash. So when you're starting with cash book, make the adjustments only in the cash book. There's a method that you do with the hand, like up and down. I just in an example, I'll show you in the next question. Okay, but if you're starting with cash book, make changes only in the cash book. Do not make any changes in the passbook. Do not make any changes in the passbook. If you're starting with cash book, make the changes only in cash book. Okay, we'll see how to make that in the next coming question. We have in question example 1. Here the balance is given as per passport. Balance is given as per passport. Okay, we'll take up the question here. Bank balance as per passport. That is nothing but 10 lakh. It is given as 10 lakh. We need to add certain items. We need to minus certain items. We need to add certain items. We need to minus certain items. Okay. So we'll see. We'll look into it one by one. What are those items? Okay. So here, first one. Since we have taken passbook, all the changes have to be made in the passbook only, not in the cash book. Okay. Check deposited in the bank, but no entry was passed in the cash book. So checks deposited in the bank. The bank checks has been deposited, but no entry was made in the cash book. So what happened? See here, I'll show you how we make it here. Say this is the cash book. This is the passbook. Okay. So checks deposited in the bank, but no entry was passed in the cash book. When the check is deposited in the bank, what will happen? The passbook balance will be high. The passbook balance will be high. So we have to make changes only in the passbook. Don't touch the cash book. Okay. So balance will be high. Checks deposited in the bank, but no entry was passed in the cash book. So when check is deposited in the bank, the bank balance will be high. So to make it equal, what should we do? We have to reduce it. To make it equal, what we have to do? We have to reduce it. Since it's high, to make it equal, we have to reduce it. So minus 5. Minus 5. Okay. Next one. Check received, but not sent to bank. Check received, but not sent to bank. So when you're here only, when you're receiving a check, okay, in the cash book, you would have recorded. In the passbook, what will happen? The bank balance will be less. The bank balance will be less. But in the cash book, you would have recorded. Okay, but we have to make changes only as per passbook. So think only in the point of view of passbook. So in the passbook, what will happen? Check received, but not sent to bank, which means in the bank, it's not been recorded, which means the balance will be less. In order to make it equal, we'll have to increase the balance. In order to make it equal, we have to increase the balance at 11,20,000. Okay, this is a very important topic, but lesson wise you have to get to know. It's too hard, it's too. If you miss out on, if you take either ways, no, the balance you won't get. The balance you won't be getting. Okay. So be careful whether to add or minus. So this is an easy trick. Okay, everybody follows this. They'll be using the hand, but since I can't show you, I'm just showing it here. Okay, the plus and minus, how it happens, increase and decrease. Then credit side of the bank column cast short. So what is happening here? Credit side of the bank column. Credit side of the bank column means in the cash book only. No, bank column will come in the cash book only. Bank column will come in the cash book only. So credit side of the bank column is less. In the cash book, it is less, which means in the passbook, it is more. In the cash book, it is less, which means in the passbook, it will be more. Okay, credit side of the bank column, cash short. In the cash book, it is less, which means in the passbook, it is more. If it is more, what we have to do? If it means if it is more, what we have to do? So then what will happen? This is nothing but we have credit side of the bank column, cash short. Credit side of the bank column. What is the credit side of the bank column? Which is nothing but withdrawals. Okay, which is nothing but withdrawals. If the withdrawals is less in the cash book, okay, so what will happen? The balance will be showing more. In the question it's saying credit side of the bank column, which means the withdrawals. Credit side, debit side is the deposit, credit side is the withdrawal. Withdrawal is showing less, which means the balance will be more in the cash book. In the cash book, if the balance is more, in the passbook, the balance will be less. Okay. In order to make it equal, you need to add this. So add 2000. So add 2000. Credit side of the bank column, okay? You need to understand the credit side of the bank column is nothing but withdrawals. If withdrawals is less, which means the cash balance will be more. Okay. If the cash balance is more in the cash book, passbook will be less. Passbook is less, to make it equal, we need to add. So we are adding 2000. Done. Insurance premium paid directly by the bank under the standing advice. Insurance premium paid directly by the bank. Expense. So bank is paying directly the expense. So what will happen? The passbook balance will be less that time. In order to make it equal, we have to add that. That is nothing but 60,000. Okay. Done. Next one. Bank charges entered twice in cash book. So expense have been recorded twice in cash book, which means the balance will be less in cash book. If the balance is less in cash book, passbook balance will be high. In order to make it equal, we'll have to reduce it. So reduce 2000. Okay. Check issued but not presented to the bank for payment. Check has been issued in the cash book. If you're issuing the check in the cash book, which means for payment, cash balance will be less. If the cash balance is less, what will happen? If the cash balance is less, in the passbook, the balance will be more. In order to make it equal, we'll have to reduce it. In order to make it equal, we have to reduce it. Okay, that is nothing but 5 minutes. Okay, next, check received. Check received entered twice in cash book. In the cash book, we are entering the deposit twice, which means the cash balance will be increased. Cash balance will be increased. Cash balance is high, passbook balance will be low. In order to make it equal, we'll have to increase this. Okay, so add 10,000. Next, bills discounted, dishonored, not recorded in the cash book. Bill has been discounted. Okay, if when your bill is you're discounting and it's been bill discounted, dishonored, not recorded in the cash book. The bills discounted, which has been dishonored. Okay, you're discounting the bill, and that person is not paying that bill, because of which it's becoming dishonored. Okay, which is not being recorded in the cash book. If it is not recorded in the cash book, what will happen? If it is not recorded in the cash book, what will happen? The balance will be more. The balance will be more in cash book. So in the passbook, the balance will be less. In the passbook, the balance will be less. The balance is more in the cash book. Passbook balance will be less. Okay. In order to make it equal, we need to add this. In order to make it equal, we need to add this. Fine. Okay. So when you balance the figure, you'll be getting an amount. You'll be getting an amount. I hope you understood this question. Okay. We'll move on to the next question. So we discussed about the adjusted cash book, right? This is an example for the adjusted cash book. Okay. This is an example for the adjusted cash book. So what happens here? The question says, according to the cash book of Gopi, there was a balance of 44,50,000 in his bank on 30th June 2022. So, okay, fine. Then what are they asking to prepare? To make the appropriation adjustments in the cash book. In the cash book, and to prepare the statement reconciling it with the bank passbook. Okay, done. We'll take up this. So what we have to do first, we have to prepare adjustments. We have to make appropriate adjustment in the cash book. So open a cash book account in the cash book. we'll have to take the balances. What is the opening balance? There was a balance of 44 lakh 50,000. And this is the balance. Debit balance. Okay, this is debit. We have credit. Checks amounting to 6 lakh issued to the creditor have not been presented for payment till date. Checks paid into bank amounting to 11 lakh 5,000, out of which checks amounting to 5 lakh 50,000 only collected by the bank to 30th June 2020. These two are BRS items. Okay. There's no adjustment. Whichever is not recorded in the cash book, we'll record it. But these two are already the checks amounting to 6,000 issued to creditor have been presented for payment till date. Have not been presented for payment till date. So with already recorded in the cash book, but in the past book it's not recorded. Okay. Checks paid into the bank amounting to 11 lakh 5,000, out of which checks amounting to 5 lakh 50,000 only collected by the bank. Which means in the cash book already entry has been made. The passbook no entry has been made. Okay, for the difference amount. So this is the BRS item for which we have to make changes in the passbook. Okay. Cash book, these both transactions already the entry is made. Okay. Then coming to the next one, third one. A dividend of 40,000 and rent amounting to 6 lakh received by the bank, okay, and entered in the passbook, but not recorded in the cash, but not recorded in the cash book. So we have to record it now. What is that? Dividend of 40,000. So we are getting an income of 40,000 and rent amounting to 6 lakh received. Rent they say received, which means an income. Record that also. Okay. These two things have been recorded. Then instance premium to 31st December 22 paid by the bank 27,000, not recorded in the cash book, not recorded in the cash book, which means so we'll have to record it now for 27,000. That is payment 27,000. The payment side of the cash book had been undercasted by 5,000. The payment side of the cash book has been this is the payment side. The credit side is the payment side. This has been undercasted. This has been undercasted by 5,000, which means less, which is showing less. Withdrawals is showing less by 5,000. Now we'll show that. Now we'll show that 5,000, which is missing. We'll enter it now. Okay. Bank charges 1,500 shown in the passbook had not been entered in the cash book. Bank charges again, it's an expense. So recorded 1,500. Recorded for 1,500. Okay. Then a bill payable of rupees 2 lakh had been paid by the bank but was not entered in the cash book. Bills payable by the bank, bills payable of rupees 2 lakh have been paid by the bank but not entered in the cash book. So not entered in the cash book means recorded. It's not entered and will enter the 2 lakhs. And bills receivable for 60,000 had been discounted with the bank at a cost of 1,000, which had also not been recorded in the cash. So 60,000 bills receivable has been discounted, which has not been recorded in the cash. So when you're discounting, you'll be receiving the money. So what is that money? 60,000, the cost of 1,000. So 59,000 will be received. 59,000. Okay. So this is the balance which we'll be getting. So just balance this account and you'll be getting a balance. You'll be getting almost to your debit balance. You'll be getting overall difference. The excess will be getting. So you can take this balance. Okay. Fine. Then according to the cash book of now, we have a balance of this balance. We have to make the difference. We'll be getting a balance of 1 second. Let me get through it. So we'll be requiring this balance, okay, to find the balances. We'll just start with the balance. Yes. We'll be getting a balance of 49 lakh 15,500. 49 lakh 15,500. So what is the balance? This is the cash book balance. Cash book balance, we are getting 49,000, 49 lakh 15,500. In this, we need to give these two adjustments. Okay. Checks amounting to what is number plus minus. Checks amounting to 6 lakh issued to the creditor have not been presented for payments till date. So we'll take that. So this is as per cash book. This balance is as per cash book. So we have cash book here and passbook here. Okay. So in the cash book, checks amounting to 6 lakh issued to the creditor have not been presented for payment till the date. Have not been presented for payment till the date. So in the cash book, we have already recorded. In the cash book, we have already recorded, which means the cash balance will be less. In order to make it equal, we'll have to increase. We'll have to make increase. But at 6 lakh. At 6 lakh. Then checks paid into bank amounting to 11 lakh 5,000, out of which checks amounting to 5 lakh 50,000 only collected by the bank to the creditors. So in the cash book, we would have recorded the full amount. The cash book, checks paid into bank amounting to 11 lakh 5,000, out of which checks amounting to 5 lakh 50 only collected by them, which means the remaining is not collected by them. In the cash book, will be showing a high balance. Okay, since we have recorded the full amount, but in the bank, we have collected only so much. So in order to make it equal, we'll have to reduce it. We'll have to reduce it. How much? 5 lakh 50, 11 lakh 5,000 minus 5 lakh 50. It will be 4 lakh 50, 5 lakh 55,000. 11 lakh 5,000 minus 5 lakh 50, which will be minus 5 lakh 55,000. So we'll be getting an answer. We'll have to just add in less this, we'll be getting an answer. Yeah. So I hope you understood the BRS chapter. And this, more or less, if you know this, this is more than sufficient. And if you should have to solve more questions with respect to this chapter, in this chapter, in every attempt, the question has come for up to like 5 to 10 marks. So if you're good in this chapter, you'll be able to score up to 10 marks. So this is the main thing which you need to know in this chapter. Apart from this, there's nothing that important which you need to know. More or less, if you know this, that is more than sufficient. Okay. Thank you. Hello, students. In today's class, we're going to discuss about the topic inventories. Okay. This is a continuation of the revision series. In today's topic, we're going to discuss about inventories. Done. First thing, what we'll learn in this inventory, first thing is definition. We'll learn the definition. This definition is very important in inventories. Inventory can be defined as assets. It is first defined as an asset. Okay, held for sale in the ordinary course of business. It is held for the sale in the ordinary course of business or in the process of production for such sale. Okay, then or for consumption in the production of goods or services for sale, including maintenance, supplies, and consumables, other than machinery spares, servicing equipment, and standby equipment. Okay, so this definition is very important. You need to learn this definition. So, what does say? Inventory can be defined as assets held for sale in ordinary course of business. This is the common which everybody can remember. Yes. We'll also learn the other point that says or which is used in the process of production of such sale. Say this is in a manufacturing industry, no? We'll be requiring some raw materials to make to convert the product into finished goods. Okay, that is the meaning. It says in the process of production of for such sale. Okay, or for consumption in the production of goods or services for sale, which is used for consumption, including maintenance, supplies, and consumables, any other type, which does not include machinery spares, servicing equipment, and standby equipment. Inventory does not clearly include machinery spares, servicing equipment, and standby equipment. Okay, these are not inventories. These are not inventories. Okay, done. Effect of inventory on cost of goods sold and profit. Okay, what affected the inventory, the closing stock? Basically, inventory means opening stock and closing stock. Opening at the beginning of the year, closing at the end of the year. Effect on inventory on cost of goods sold and on profit. Okay, first we'll see what is the effect on profit. First we'll see what is the effect on profit. So here, closing stock is directly related to profits. Closing stock is directly related to profits, which means if closing stock increases, the profit also increases. If closing stock decreases, the profit also decreases. Okay, so how is this done? So basically, imagine this is a trading account. This is a trading account. In trading account, we have opening stock, we have purchases, and some direct expenses. We have direct expenses. Okay. Then we have profit. Here, similarly, we'll have sales. We'll have sales. Then we'll have closing stock. Closing stock. Say, for example, imagine the volume wise. Okay. Imagine just volume wise. Say this has four quantities: one, two, three, four. So this side also, sales is having two quantities. Say closing stock is having two quantities. Okay, equal. Both has to be equal. No, four and four. Okay. So what happens when the closing stock increases? When the closing stock increases, which means here, say one more box is added. Okay. So profit here, the only thing that will change is the profit. Profit also one box to be added. So when the closing stock increases, so here three it's become, here it has become two, increases. If say one more it becomes, one more closing stock increases. That time here also it increases. Okay, so this is how you can remember this. So basically closing stock is directly related to profits. Closing stock is directly related to profits. So when closing stock increases, once again, so when the closing stock increases, the profit also increases. When the closing stock decreases, profit also decreases. Okay. So this is in case of closing stock. What about opening stock? What about opening stock? Reversal. So opening stock, what happens here? In opening stock is inversely related to profits. If the closing opening stock is increasing, the profit will be decreasing. If the opening stock is decreasing, the profit will be increasing. Okay. So the opening stock is inversely related to profits. So how does it happen? Same example we'll take. The previous question we took. No, similar example we'll take. How it works. So basically, same. And we have a opening stocks, purchases, direct expenses, and gross profit. We'll have sales and we'll have closing stock. Okay. Say for example, opening stock we have one quantity. Okay. Just example. Just remember this way. Okay. So say for example, gross profit we have. So here also two has to be there. Four has to be there. So I'm just dividing it equally. So quantities are four and four. Say for example now, opening stock is increasing. Opening stock is increasing, which means this is adding. One quantity is added. So where can you adjust this? It has to be adjusted to the profit only. Correct. No, when this is increasing, we'll have to remove here. This has to be removed. Correct. No. Let me take it in this way. Say for example, we have two opening stock quantities and this we get we have. Okay, here there's five and I get six. Gross profit also we have two. This is total is six, this total is also six. So what happens when the opening stock increases? Opening stock increases, I'm adding one quantity here. When I'm adding one, I have to reduce one and gross profit here. I have to reduce one. Only then the total six will match. One, two, three, four, five, six. Six quantity will match. So when it's increasing, this gross profit will be decreasing. So in the other case, what will happen when opening stock is decreasing? Say we have decreased by two quantities. Okay, it's reducing basically. When it's reducing, we have four. Here we have six. So we'll have to match it. That is, we'll have to add another two. So this is the inverse relationship which you can see. Okay, I hope you understood. So basically, closing stock is directly related to profits. Closing stock has direct relationship. Direct relationship. Opening stock has inverse relationship. Inverse relationship. Okay, done. Then coming to closing stock and cost of goods sold. Closing stock and cost of goods sold. Okay. Similarly, here, closing stock and the cost of goods sold will be having inverse relationship. If at all the closing stock is increasing, the cost of goods sold will be decreasing. If the closing stock is decreasing, cost of goods sold will be increasing. Okay. Similarly, with respect to opening stock, it shall have direct relationship. With respect to opening stock and cost of goods sold, it shall have direct relationship. If the closing stock, opening stock is increasing, the cost of goods sold also will be increasing. If the opening stock is decreasing, the cost of goods sold will be decreasing. Okay. So no need to remember everything. So it'll be confusing for the exam. So just remember with respect to the closing stock. Just remember with respect to the closing stock and the profit. Just remember with respect to the closing stock and the profit. Closing stock and profit. When the closing stock is increasing, profit also increases. Closing stock decreases, the profit also decreases. Okay, just remember this so that other things you can easily get. Okay, done. Then coming to the formula of cost of goods. Okay, what is the formula? Opening stock plus purchases plus direct expenses minus closing stock. Okay, this is the formula to find the cost of goods. This means cost of goods. Whatever goods are sold, no, that is a cost. The cost of that whatever goods are sold. Okay. In order to find that cost, you need to add opening stock plus purchases plus direct expenses minus closing stock. This is the formula which you need to remember. Okay. Done. We'll move on to the next one. Coming to inventory valuation. Inventory valuation. What is inventory valuation? Inventory valuation means at what value you record the inventory in the books of accounts. At what value you record this inventory of stock. Inventory or stock you record in the books of accounts. Okay. So generally, inventories are valued at cost or net realizable value, whichever is less. Generally, inventories is valued at cost or net realizable value, whichever is less. Okay, this is the general rule. Okay, sure. We have multiple adjustments, what to be included, what not to be included. We'll discuss that one time. Okay, but the thumb rule is inventories, the stock is valued at cost of net realizable value, whichever is less. Okay, then the cost of inventory, the cost of stock. What does the cost of inventories include? Okay, does that include only the buying price? Yes, so it includes the buying price, not only the buying price, but includes the buying price plus the cost of conversion and other costs incurred in bringing the inventory to the present condition and location. Okay, it also includes with the cost of purchase, it also includes cost of conversion, which means the converting the basic raw material into the finished goods. Okay, that also if it's in work in progress stage, no, we need to add the cost of conversion also to show the closing stock. Okay. It also includes other costs incurred in bringing the inventory to the present condition and location. Anything like packing, transportation, if it's directly related to the inventory, you can add it to the inventory itself. Okay, this is what it says. Any tax, duties, all that. Okay. So for individually, we'll see what all these costs are. So cost of purchases. Cost of purchases. What is cost of purchase? Purchase price which you're paying. If any duties and taxes which are being paid, this is duties and taxes, non-refundable duties and taxes. Only non-refundable duties and taxes to be considered. Okay. Then any freight inward, if freight inward, if anything is there, to bring it to the location, that also will be included in the cost of purchase. And other expenses directly attributable. If any other expenses like packaging, that is, if anything which is directly attributable to the cost, you can consider that expense also in the cost of purchase. Okay. Then you have to less duties and taxes recoverable. If the duties and taxes are recoverable, that is refundable, recoverable, that time you should not consider these duties and taxes. If it is not recoverable, then you are only then you have to add all this to be added: purchase cost, duties and taxes, freight cost, and this other expenditure. This also add. This you need to less, which is recoverable. And trade discount. Trade discount directly reduce it from the value of the inventory itself, from the value of the purchase price itself, directly you reduce the trade discount. Okay. And repeating things are etc. Cost of conversion. Cost of conversion. We have here cost of conversion. So we see what does cost of conversion include. Cost of conversion includes mainly the labor. Labor costs. Okay, that is the major cost which is taken into consideration for the conversion. Okay. Apart from that, it also includes variable production overhead. Variable production overhead. If any overheads will be there, no, if you are able to particularly bifurcate for this particular inventory, this particular stock, then that also you can consider. Okay. Only if you're able to bifurcate it. Okay. Only then you can consider the variable cost. Because, for example, say machine hours will be there. No, machine hours. We'll be using the machine particularly for that type of inventory. So that machine hour can be taken into the cost price, cost of conversion. Okay. That is nothing but variable production overhead. Okay. These are the things which you need to know. Then coming to in this only we have cost does not include. There are certain items which is not included in the cost. We saw what is to be included. So these are the things. No matter what, it won't be included. What is that? Administration cost. This is a general admin cost. Okay, this is not to be included. Selling and distribution cost. Selling and distribution cost. This is also not to be included. Then finance cost like interest, bank charges, etc. Okay, this also we do not include. Then storage cost. Storage cost of the inventory, which is being incurred. You'll be paying some rent and all. No, that will not be included. Okay. These are the costs which not to be included. Then we have a note. This is very important. Okay, what does this name say? Note, normal wastage is included and abnormal wastage is excluded from the cost. What is normal wastage and abnormal wastage? Normal wastage is manufacturing process. No, there'll be variant. There'll be some items which is being damaged. In the manufacturing process itself, the output what we get may not be in a good condition. There may be some defects. All of that will be considered as normal wastage. All of that will be considered as normal wastage. Abnormal wastage is nothing but if at all abnormally, like say fire has been caught in the that production process. There's a fire. Okay, that due to which the stock has been lost or some theft has been happened. So all of that will be considered as abnormal wastage. Okay, normal wastage anyway that will be given effect in the the trading account directly. Here abnormal wastage to be given effect in the P&L account. Okay, in the P&L account as loss by fire or loss by theft, whatever names that will be given that. Okay, so normal wastage will be directly included in the cost of an inventory, but abnormal wastage will not be included in the cost. Okay, done. Then we have net realizable value is defined. What is net realizable value? We spoke about NRV, like cost or NRV. What is this NRV? NRV is defined as estimated selling price in ordinary course of business, less estimated cost necessary to make the sale, and also deduct estimated cost of completion. Okay, NRV is nothing but the net realizable value. If you sell it in the open market, now what is the value you will be realizing? Okay, in that you will have to minus the selling cost. And if you're incurring any additional selling cost or during the selling this item, that cost also to be reduced. After reducing this, whatever the value you're getting, that is the net realizable value. Okay. Is defined as the estimated selling price in ordinary course of business, less the estimated cost necessary to make the sale, and also deduct estimation cost of completion. Okay. Then, when finished goods are not expected to fix the cost and there is a decline in the price of material, so finished goods will have a selling price. Okay, so will have a selling price. If are not expected to fix the cost, so this will have a selling price and this will have a minimum cost which is incurred to manufacture the product. Okay, so if they're not able to fix the cost and there is a decline in the price of a material and other supplies, then materials are written down to another. Same in case of basically here what happens is we have three types of materials. We have three types of inventories. What is the three types? One is raw materials, one is work in progress, and one is finished goods. Okay, sure. We discussed that inventory to be valued at cost or NRV, whichever is less. Okay, this is what we discussed. Okay, so we have three different types of inventories. We have raw materials, work in progress, finished goods. Okay, how do we value all these three? So finished goods here we can value it at cost of finished goods in usually we have a selling price. But in our books of accounts, we have to realize it at cost or NRV, whichever is less. Okay. We have to realize it at cost or NRV, whichever is less. In this, you can manage the selling expenses. NRV, if you're taking any selling expenses to be incurred, that also can manage. Okay. To be recorded at cost or NRV, whichever is less. Okay. Then coming to working progress. When coming to working progress, what happens is, so say for example, the or in the production process, the completion, the product is completed only to say to an extent of 70%. Only to an extent of 70%. The product is completed only to an extent of 70%. So remaining balance 30% is not completed, not yet completed, to be known. So what will happen that time? This the 70% which is completed is nothing but the cost, which is already incurred. Cost which is already incurred. This 30% is not incurred, cost yet to be incurred. Okay. So here to be valued at cost plus the conversion cost to be incurred. Okay. We'll have to reduce the conversion cost which to be incurred here and minus the selling expenses. Okay, this is how you value the work in progress. So basically, you can't sell the item which is half finished. No. So that is why what you do is you take the cost, that is the 70% cost here, and with that you minus the additional cost which to be incurred. That is for 30% additional cost which to be incurred. That will be incurring in the future. So reduce that cost from this. Okay. Then also reduce the selling expenses. Done. Then coming to raw materials. Raw materials, see, you're buying a product, buying a raw material not to sell in the ordinary course of business. Raw material is what? Not to sell in the ordinary course of business. So that is why, so you'll be requiring the raw materials to bring it to the finished goods, to convert the product into finished goods. So that is why raw materials is valued at replacement cost. Replacement cost. Replacement cost is nothing but, say for example, if you want to buy raw material again, say for example, you bought raw material at 10 rupees, okay, per quantity. Now, if you want to buy the raw material, the outside market, I'd say at 9 rupees every time. Okay, so you have to record it at 9. Similarly, if you're getting it at higher price, that price will be recorded. Raw materials will always be recorded at a replacement cost. Okay, at a replacement cost. Done. We'll move on to the next topic. Methods to determine cost of inventory. See, there are various methods to determine the cost of inventory. Okay, we'll have to find the value of closing stock. We'll have to find the value of closing stock at the given point of time. That is nothing but at the end of the year, that is 31st March. You need to find the value of closing stock at the end of the year. Okay, so for that we have different methods which is being given. Okay. We'll look into it one by one. What is the first method says? First method is specific identification method or specific cost method. Specific identification method or specific cost method. Like in the name only suggests, specifically you're able to identify the stock. Okay. Since you're able to identify the stock specifically, so each, say for example, you have a stock of A, B, and C. Okay. And A, B, and C specifically, you know, this stock is there, and this the historical cost of the stock is say 10, this is 20, and say this is 50. And the net realizable value for the stock is say 9, this is 25, say this is 40. So here cost and NRV, you'll be taking cost and NRV basis. What is the cost and NRV? You'll be taking this is this, net realizable value, this is this here, and again this is this here. You're able to identify the lead stock value. So you'll be taking cost and NRV basis, and you'll be valuing those on the closing date. Okay, this is called specific identification method. Specific identification method, whether you're able to differentiate the stock which is there. Okay, we are able to differentiate the stock which is there. We'll just run to the query what is given here. It is possible to link a particular item in a stock with a particular purchase. Such item can be valued at its specific cost. AS2 states that the cost of the inventory of items that are not ordinarily interchangeable should be valued at the specifically identified individual cost. Okay. Similarly, the goods and services produced and segregated, kept aside for specific projects should be valued at the specifically identified individual costs. This method tracks the actual physical flow of goods. This method is also called actual cost method because specific job bears the actual cost of materials bought for the job. This method is suited for antique shops, expensive jewelry, or customs made merchandise. Okay. Basically, specifically, you're able to identify each stock value. That is why you take this method. Yeah. So this method is used in antique shops, expensive rendering, custom made, merchandise. All of these methods will be using this method. Then we have first in, first out. FIFO method. This is the commonly used method. Okay. Nothing FIFO method. F first in, first out method. What does this method say? Whichever inventory, whichever the stock which is purchased first. Say for example, we have purchased lot one. Lot one has been purchased. Then again we are purchasing lot two. Then again we are purchasing lot three. Lot by lot, we've been purchasing goods. Okay. So whenever you're selling, whenever you're making sales, no, the first sale will be made from the lot one. Okay. After you exhaust the lot one, then you'll be using from lot two. Then after you exhaust lot two, then you'll be using from lot three. So whichever you purchase first, you'll have to sell first or use first. Whichever you're purchasing first, that has to be sold first or it has to be used in the production of manufacturing first. Okay. So the goods which have been bought last, no, we'll be using that in the last. Okay, in the later stage, we'll be using this. That is called first in, first out method. This is a commonly used method. See, whenever if the goods are perishable or if the goods are technologically where technology is significant, no, then all this first in, first out method can be used. Can be just to make it more clear. This method assumes that the items received first are issued, means sold or consumed first, so that the latest items are in stock. In this method, an issue is valued at the oldest rate. An issue is valued at oldest rate as in this is the first, this is the latest, this is the old one. So this is a new one basically. This is latest purchase. No, so I have to old rate at plot number one. That rate will be one. The FIFO formula assumes that the items of inventory which are purchased or produced first are consumed or sold first. Consequently, the items remaining in the inventory are those most recently purchased or produced. Read this. Consequently, the items remaining in the inventory are those most recently purchased or produced. So the unit will be having some inventory. No? Say, for example, we have 100 quantities in the inventory. So if at all 100 quantities is there, that will be from the latest purchase, that will be from the lot. Okay, the initial purchase would have been sold or consumed. That's what it says. Okay, however, understood. We'll move on to the next topic. So all these are methods to determine the cost of inventory. Okay, the first one is specific identification method. Second one is FIFO, first in first out method. Next method which we're going to discuss is last in first out method. Last in first out. It's called LIFO, last in first out. Similar way we saw, no, we had three lots. Lot one, lot two, lot three. Okay. In last in first out method, what will happen? The lot which is being purchased recently purchased is this. We'll be using this first. This will be used first. Then after this has been exhausted, we'll be using this. After this has been exhausted, we'll be using this. In this order, we'll be using the inventory or we'll be selling the inventory. Okay. That is why it's called LIFO method. Last in first out. Whichever is purchased last has been sold first or consumed first. This method is just the opposite of FIFO. It is the opposite of FIFO. Whatever we discussed in FIFO, it's just the opposite here. It assumes that the items received last are issued, sold or consumed first, so that the earliest item are in the stock. So, for example, say we have 100 quantity stock. No, the stock will be from the lot one. The stock, whatever we have, that should be from the lot one. Okay. In this method, the issues are valued at latest rates, while the stock are valued at oldest rate under this method. The cost of goods sold will be at a price same as current replacement cost. Because when you're selling the item, you'll be selling here from here first. So it'll be at a replacement cost. Whatever you're buying, it will be at a replacement cost. Okay. So this you need to remember, whichever is purchased last has been sold first. Done. And then we have weighted average cost method. What is this weighted average cost method? Say, for example, you're buying uh, product A, product B, product C. Product A, you're buying 100 quantities for 50 rupees. Say, for example, then again you're buying product B, 10 quantities at 70 rupees. Say, product C, you're buying another 10 quantities for 20 rupees. Okay. So you're buying different quantities at a different price. You're buying different quantities at a different price. So what happens the total here? What happens the total here? The total will be 50 into 100. That will be 5,000. 70 into 10. 700. 20 into 10 will be 200. We'll just take 30 for easy calculation. We'll just take 30. That will be 300. So total we have 6,000. Total we have 6,000. Okay. So here what happens is we give a weight. Okay, we give a weight. According to the weight, we need to calculate the average price. It says weighted average cost method. See here we have only three stock and we have a given quantity here. It's able to we are able to identify the stock which is available, which is not available. But in a huge big MNC company, they won't be able to identify each particular stock. So that's why they'll be using weighted average. They'll take the weights and they'll be using an average price in that. Okay. So whatever the goods they've been purchasing, they'll be storing it in one location. Whatever the stock is remaining there, they'll be using a weighted average cost. So how do we use this weights here basically? So basically, for using this weights, we need to give the weight whatever is given here. No, we take this into consideration. We take this into consideration. So basically, here the we'll have to see the weighted average. So we have got the total value here, but the weighted average we have to see 6,000. There's total is 6,000 divided by the number of quantities what we have. That is, we have 120 quantities. 100 plus 10 plus 10. Okay. So you'll be getting around 6,000 divided by 120. 6,000 divided by 120. So you'll be getting at 50. 50 will be the average price, average cost. So whichever lot you sell the goods, the cost will be taken as 50. The cost of goods sold, whatever you're selling, will be taken as 50. Because the average price what we've taken is 50. Because the average price what we've taken is 50. Okay. This is the using the weighted average. Weighted average cost method. Similarly, instead of weighted average, we have a simple average method. Next, we'll look into it. In simple average method, under this method, closing stock is valued at average purchase date, okay, without giving any weights. In this method, stocks are valued at an average of old and new rates. Simple average cost means the arithmetical average of all the purchases rate. The simple average rate is equal to all purchase rate divided by number of purchases. It should be noted that the quantity purchased are not relevant at all. So here, in the previous example, we took the quantities. That is, we took the 100 quantity into 50. Here, the quantities we took in order to find the average. Okay, whatever the total we got, in that we divided by the number of quantities. But here, whatever the purchase is there, no, whatever the purchase, without giving any weights, we need to do. That is called simple average method. So all purchase rate, whatever is there, all the purchases, whatever is there, be directly divided by number of purchases. Directly divided by, say for example, you're purchasing, similar last example only we'll take, that is we have purchased at 100 plus we have purchased at the price of, we'll take the price. Okay. We'll take the price as 50, 70 and 30. 50, 70 and 30. And we have made three purchases. Okay. Here 50, the total will be 150 divided by number of three purchases. 3 will be 50. See, in this case, they have taken an easier calculation so that we are getting both here same answers. Okay. But generally, this won't be the case. Here, we are taking only the purchase price, dividing it by number of purchases. So we are getting 50. Here, with the quantity, multiplying the purchase price, then we are getting a total. In that total, we are dividing it by the quantity. Then we are getting the weighted average price. Okay, here the quantity is playing a role. Quantity is nothing but 100 plus 10 plus 10. Okay, quantity is playing an important role. But here, we are not considering the quantity. That is called simple average method. Okay, done. Then coming to adjusted selling price method. This is an important method. We come into your exam point of view. This is an important method. What is adjusted selling price method? So here, they want, like in previous methods, what we discussed, specific identification method, LIFO, FIFO, and simple average, weighted average, all that we discussed, right? Here, adjusted selling prices, they just have a margin, they just have a profit margin. They'll just have a profit margin, say 10%, 20%, whatever might be the margin. Okay. Whatever might be the margin. So, based on this, they'll be calculating the closing stock. We just go through the theory, then we'll come, I'll explain you with an example. This method is also called retail inventory method. Adjusted selling price method is also called retail inventory method. It is widely used in retail business or in business where the inventory comprises of items, the individual cost of which are not readily ascertainable, which means that the individual item cost are not ascertainable. We are not able to find individually if you see. Specific identification is not possible. And FIFO LIFO also is not possible. In that case, the use of this method is appropriate for measuring inventories for large number of rapidly changing items. We have many items which is large numbers and which is rapidly changing that have similar margins, which has similar margins is very important. Say, for example, in an consumer goods, they have a lot of products, okay, but they might have similar margin. So based on margin, they find the closing stock value, and for which it is impracticable to use other costing methods. Like we discussed, other methods we are not able to use. The cost of the inventory is determined by reducing from the sale value of the inventory and appropriate percentage of gross margin. Say, for example, sales we are made for 10 lakhs. Say, profit margin is 10% on sales. 10% on sales. If it's specified on sales, minus 10%. That will come about 1 lakh. Remaining is 9 lakh. Remaining will be 9 lakh. Okay. Then coming to the percentage you use takes it half. This point is very important. This point is very important. The percentage used takes into consideration inventory which has been marked below its original selling price. Say, for example, all the inventories have been sold at a margin of 10%. But some inventory, which is abnormal goods, now they'll be selling it at a loss or a profit. That particularly will be given in the question. Okay. I'll have an example sum. I'll show you how it is done. As of now, we'll just post the theory. In examples sum, I'll explain in detail this. The percentage used takes into consideration inventory which has been marked below its original selling price. An average percentage for each retail department is often used. The calculation of estimated gross margin of profit may be made for individual items or groups of items or by departments as may be appropriate to the circumstances. Okay. Adjusted selling price method is basically nothing but a profit margin. The exam point of view, if you see, this is the method which they'll ask you. Okay, practical, not theory. Practically, they'll ask you this. And this is an important adjustment. Percentage use takes into consideration the inventory which has been marked below its original selling price. Okay. Done. We'll go to the next time. Comparison or the impact of FIFO and LIFO. Okay. This FIFO has to come here. Okay. Not here. FIFO, LIFO. It has to come here. Under the inflationary conditions, when the prices of the stock, the price of inventory are rising, that time what will happen? The closing stock, when it's increasing, the under FIFO method, the closing stock will have high value. Why? Because since we discussed lot 1, lot 2, and lot 3. 3 lots we have. So in FIFO method, you will be selling the first lot. You'll be selling the first lot first. Then this third lot will be sold last. So this will be the remaining in the closing stock. This will be at a recent price. So the recent price is increased, rising price. And this price is increased, which means the closing stock will be high. LIFO, it's just the opposite. Okay. LIFO, it's just the opposite. So for example, if closing stock is high, what about the gross profit? This has a direct relationship. No, this will also be high. Okay. Then coming to cost of goods sold. Cost of goods sold will be low. Why it will be low? Because here, whatever the cost, here you'll be using the initial lot. Because the prices are increasing. Here, 100, 110, 120. Same rising prices. So this stock will be used for the production or sale. So because of it, the cost of goods will be low since they use this. Okay. Then coming to deflationary condition, that is prices are falling. When prices are falling, that will be Opposite to this. In FIFO, inflationary condition, rising prices we saw, right? Here it is low. Similar way, others also will be found this. Right? Closing stock and gross profit has a direct relationship. So if it's a closing stock is reducing, gross profit also will be reducing. Okay. I hope you understood. This is not that important, but we're just covering all of which is there in the book. Then coming to the inventory record systems. Inventory record systems. There is basically two types of recording inventory. That is nothing but periodic inventory, periodic system of inventory, perpetual system of inventory. What is periodic and perpetual? Inventory record system means how do you maintain the records of inventory? In that we have two methods. Closing stock can be ascertained either at the end of the specific period or after each transaction in stock. There are two systems of inventory. One is periodic, perpetual. Periodic method is nothing but a physical counting method. Physically, you count the stock at a given point of time. Say usually at the end of a month, end of a week, end of the year. Okay, under periodic inventory system, closing stock is ascertained by taking an actual physical count of all the inventory on hand at a particular date. Okay, this value of stock in such state is equal to quantity of stock ascertained into date. Okay, this is by periodic system of inventory is nothing but physical count. You go to a warehouse, you physically count the inventory which is lying at the warehouse. Then you get a physical count of the inventory. That is nothing but periodic system of inventory. Periodically, you count the inventory which is lying in the warehouse. Then come into perpetual system of inventory. Perpetual system of inventory here, physical count is not done. Wherein they use a particular software wherein for each purchase and sale, automatically plus minus something. Say for example, you purchase 100 stock. You purchase 100 stock. In this, say for example, you have sold 10 quantities. Immediately the software, then punch in the software, immediately 10 quantities it is, 90 will be shown. 90 will be lying down in the warehouse. So under this perpetual system, closing stock is ascertained by taking physical count. By taking physical count from the stock ledger. It's each after each receipt and issue. So basically, each receipt and issue has been considered. Okay, the value of stock is also calculated after each transaction of receipt or issue. The perpetual system thus helps to keep constant track of high value items. The perpetual system thus helps to keep a track of high value items. Done. So distinguish between periodic inventory system and perpetual inventory system. I've just given up few points and we'll just be discussing this. So periodic inventory system based on physical verification. This is based on book records. This system determines inventory and takes closing stock as balance figure. Determines inventory and closing stock as balance figure. This system determines the COGS in stores and takes inventory as a balance figure. Because here we'll have the opening stock. We'll be reducing the sales, adding the purchases. The closing stock will be the balance figure here. But here we know the closing stock. Okay, we know the closing stock. So we need to find the COGS. That should be a balance figure. COGS, which is a balance figure, includes loss of goods. Okay, closing stock, which is the balance figure, includes loss of goods. It is assumed that goods lost are sold. Here, what happens is, say for example, you have 100 quantities initially. Okay, then when you are counting the goods in this periodic inventory system, you have only 15 items. In that, 40 is only sold. So if remaining you should have 16. If only 50 is there, when you're counting balance, when 50 is there, you think remaining 50 is sold. Okay, but actually 50 is not, only 40. 10 might be lost, some theft, something would have happened. So you won't get an order in this method. But in a perpetual system, it is assumed that the goods are lost in inventory. Which are lost in inventory. Inventory control is not possible. In this method, inventory control is not at all possible. Okay, we don't know the track on a daily basis. Only at the given point of time, we can count the inventory. Okay, only during that period we'll get over. But otherwise, we don't have any control. But here we have the control. This system is less expensive. In a small organization, they just simply count the inventory orders. So it is not that expensive. Here you need to put a software, you need to train a person who actually knows this to use the software, any barcoding system, proper system to be maintained. So all of that, considering this, this system will be costly. In a big organization, they usually use this. This system requires closure of business for counting of inventory. Yes. Here, whenever they're counting the goods now, any purchase or sale has to be stopped for that particular point of time, maybe a particular day. A particular day, the business has to be stopped. You can take the purchase and sales, but goods are not supposed to come in and go out. You need to stop that for that particular day. Only you'll be getting the true value of the inventory. So this system requires closure of business for counting on it. Here it doesn't matter whether purchase or sale can happen simultaneously. We know the value of closed system. Here it can be found out without affecting operations of business. Okay, I hope you understood this. Then, then coming to stock taking. Stock taking is nothing but stock counting, physical count of the stock. Verification means physical inspection of the stock, also known as stock taking. In stock taking, the items lying in the warehouse, factory, etc., on a particular date are actually counted on measure. Are actually counted on measure. The employee is taking the stock on measure or weigh the stock and record the item in quantity. This work is done systematically so that an item is neither omitted nor counted twice. There is no movement of stock. There is no movement of stock, like we discussed during the counting. No goods are received or issued till the stock taking is completed. The stock sheets are prepared separately to show the total physical stock. That is for physical finished goods they do separately, raw materials they do separately, work in progress also they do separately. All three to be maintained separately. Okay. Then, see, this is from exam point of view. What will happen is they'll give a stock value. Say, for example, we need the stock to for close the books. We need the stock value on 31st March. But in the exam, they'll be giving the stock value as of 20th March or say 10th of April. Okay, the value will be given either at this date or this date. So whenever they give before or after, okay, how do you come to the closing date? Okay, stock taking before or after your end. So normally, there's a format given and there's few items. We'll just look into it. How do we find the closing stock? Normally, stock taking is done as on the last day. The last day is nothing but 31st March of the accounting year. However, sometimes stock may be taken on a date either before or after the end of the year. In such case, the physical stock must be adjusted for receipts and issues between the 2 days to arrive at closing stock at the end of the accounting year. Okay. So basically, they'll give stock as on this date and stock also as on this date. Say, for example, they've given stock as on 10/4. Okay. If they're given stock as on 10/4, here they're between this period to this period, we'd have made some purchase, sales, all of that. So plus and minus, we'll have to add some purchases or sales, whatever is it. We'll have to reduce and increase them. Okay. After that, only you'll be arriving at this date. From 10/4, you need to do the calculation. So you'll be arriving at 31st March. So what is the calculation? So say for example, this is the format which is there. So physical stock is given on a date after your it is something like at 10/4 it's given. At 10/4 it is given. Okay. So here what do you do here? Add sales or goods going out. Add the sales. Okay. So basically during this period, if at all if you have sold any goods, if at all if you have sold any goods, okay, the say for example here on 31st March, example, you have an inventory of 100. Okay. If you have sold any goods during this period, say 20, the balance goods you will have is 80. Balance goods you are supposed to have is only 80. So 80, we know this, we don't know this now, 10, 20, we have 80. So if at all, if you made any sales during this period, you need to add that. Only when you add this, you'll be reaching at this point, correct? No. So nothing but 80 we know. So if any sales are made, add that 20. Then any purchase return which are made during the year also to be added. Purchase return. Okay, which whatever purchase you made will be you would have returned to the vendor. So that also to be added. Okay. Then coming to purchases. Purchases. If you made any purchases, that will be there in the stock. Okay. On 31st March, it is not there. On 10th of April, it is there, which means you have to minus 2, go back. So minus that stock. Say, for example, 50, whatever. Then also minus the sales return also. Sales return. Sales return, why you have to minus that? You have sold. Okay. The sales will be minus sales. But you have got back the goods. If you're getting the goods back, again, that will be there in the stock, which is not the stock actually, as in 31st March. So you have to reduce that. You will be getting at a closing stock value as of 31st March. Okay. So there's just the format here. No need to buy this format. Just remember the concept here. We'll do an example question so that we'll be able to understand. Okay. Done. And in case of this is after the year end have given. If it is before, then it will be the opposite. This to be minus and this to be added. Okay, this to be added. Ulta. Say for example, on 20th March, the stock value is given. This is given as on 20th March. So after this date, if you're purchasing anything, to be added. If you're selling anything, to be minus. So purchase will be added. This date closing stock has been given. So they would have counted the stock as on this date. So if at all, if you're purchasing anything, then to be added. Okay. Purchasing anything as in, like if you're purchasing, say for example, 100, here you have 200, you're purchasing 100, then you have to add the same. If you're making any sales from this, to be reduced. To be reduced. Okay. Done. We'll solve an example question. Okay, we'll be able to understand better. The sales or say, some notes have been there. Let me just go through them. The sales or sales settle are to be adjusted at the cost value. This is very important. If you're adjusting any sales or sales settle, that to be adjusted at cost value because closing inventory we need to arrive at the cost, not the selling price. Closing inventory to be arrived at cost. Okay, in the question, if it is given at selling price, you need to bring it to cost. How do you bring it to cost? If some gross profit margin will be given in the question, you need to minus that. When the physical stock is taken on a date before the year end, the above formula is reversed. Same thing we discussed. No, when physical stock is taken before the year end, above formula to be reversed. Above formula as in this formula. Whatever the plus minus is there, no, we have to take that. The items added above are deducted from, and the items deducted above are added to the physical stock in order to arrive at the closing stock as the year end. Such estimated physical stock at the year end is further adjusted for stock of outsiders, stock with outsiders, or cut-off transaction as explained below. What happens here? We after doing all of this adjustment, we will be arriving at a closing stock value. Okay. Here there will be some further adjustment, as in some stock of outsiders, stock with outsiders, or some cut-off transactions will be given. What is this? We'll look into that in the next slide. So, what are the adjustments? Adjustments in physical stock. What are the adjustments in physical stock? One is stock of outside. If you're having the third party stock with you, if you're having third party stock with you, that is not your stock basically. If someone else stock you're having, that to be minus. That to be minus. Stock with outsider. See your stock you've given to somebody else, third party. Say consignment or consignment you've given, or even if it's lying with the customer, say some goods you have sent on approval basis, that is lying with the customer. That to be taken into consideration in the stock. That is your stock. Still, it is not sold, but still it is your stock to be added in the stock. Okay. Then we have cut-off transactions. Cut-off transactions as in you don't made the sale. Okay. You don't made this. This is all the adjustments in physical stock only. Keep in mind, there's only with respect to physical stock. Physical content, only in that time. Cut-off stock. Cut-off stock as in you don't made the sale. But still, the stock would have not gone out from the warehouse. The stock will be still lying in the warehouse. Okay, that time you need to make adjustment. Say, for example, you made the purchase. In the books, you've recorded the purchase. The stock is more in the books, but you have not received the stock still. Physical count, when you're making, the stock is not there. It's in transit still. Okay, that to be added. That to be added. So all of these adjustments you need to make. Okay, only then you will be arriving at a additional closing stock value. Done. We'll look into the format. Summary of adjustment to physical stock to arrive at the book stock. So physical stock will, when we take at the year end, we will be reducing the stock of outsider. Then, because since it's not your stock, then stock with consignee branch customer or customer on sale item that will be added because it is your stock. Okay. Then cut-off transaction, that is purchases made. Invoices received but stock not received. Invoice you have received recorded in the books but stock will not receive. That will be added. Then coming to reducing, when you made the sale, stock will be lying there with you. You're not still given the stock marks, but sale when the books are recorded, we'll have to minus that. We'll be coming at a closing inventory value. In the absence of information in the question, always calculate the book stock. Always calculate the books. Okay, done. Next, some important points are there which you need to remember with respect to this chapter. That is inventory of a byproduct. If any byproduct is done, always to be validated, not realizable value. Because this product is not which you're producing. You're producing something else. Out of which you got a byproduct. Okay. This to be validated, net realizable cost. Or which you can reduce from the cost of the original product as well. Then inventory is part of current asset, which is part of working capital. Working capital is not current assets and current liabilities. Working capital means liquidity position. Okay. Inventory is valued as per conservatism principle of accountancy, which states that account for future losses and but do not account for future profits. If at all, what does conservatism principle says? If any losses, we need to account for that. If there's any profit, do not account until it's been realized. As per that only, we need to value the inventory also. So that is why we follow the cost or NRV basis, whichever is less. We don't take whichever is low. We take whichever is less. That is why that is what the conservatism principle says. Cost of goods available for sale will be equal to opening stock plus purchase plus direct expenses. Cost of goods available for sale cost of goods opening stock plus purchase plus direct expenses. Accounting standard 2 recommends FIFO and weighted average method. These two methods are recommended by accounting standard 2. Accounting standard 2 is nothing but which deals with inventory, which recommends FIFO and weighted average cost method. Okay, these are some important points you need to done. Now coming to the example question 1. We have discussed a lot of topics, so we'll just do one example question so that we'll be clear with the topic answer. We'll be clear with the topic answer. Okay. Done. So what do we have in the question? On the following information, ascertain the value of stock as on 31st March. We're asking the value of the stock as on 31st March. Okay. Value of the stock as on 1/4. As on 1/4 is given. Opening stock is given. So nothing but opening stock is equal to 7 lakhs. Purchases during the period is given. So purchases and that is nothing but 34 lakh 60 34.6 lakh. Then manufacturing expenses. Manufacturing expenses to be taken in trading account. But trading expenses to be taken in P&L account. I hope you know that. Okay. So this is nothing but direct expenses. That to be added again. That is 7 lakhs. Then sales during the same period. Sales we have made, sales we have to minus. That is 52.2 lakhs. But there is some adjustment here. We'll see what is that adjustment. At the time of valuing stock on 31/3/22, a sum of 60,000 was written off. At the time of valuing stock as on 31/3/22 at the year end. Okay. At the last year end, we have valuing stock as on 22. It is given as on 21. Okay. A sum of 60,000 was written off a particular item which was originally purchased at 2 lakh, which means 60,000 was written off. The actual value is 2 lakhs. In that 60,000 written off, which means 60k minus. The actual cost which is there in the books is 1.4 lakhs. Okay. And which was sold for 1,60,000. Which was sold for 1,60,000. So 1.6 lakh if you minus, will be getting a profit of 20k. 1,40,000 worth of goods you've been selling it for 1,60,000, which means you have a profit of 20k. Because this was written off in the previous year, not in this year. Okay. But the above for the above transaction, the gross profit earned during the year was 25% on cost. So generally for the above transaction, 25% on cost. Okay. So there's one more concept as well. So if it is 25% on cost, that is something like 1/4. 25% is something like 1/4. It will be 20% on sales. That is something like 1/5. It will be if 1/4 on cost, it will be 1/5 on sales. Okay. So since we don't know, since the sales is easily identifiable, we'll go with sales. We'll take 20% on sales. Okay. Now, so what is the gross profit margin here? There's the last method, okay, which we discussed. That is the method which we discussed with. Adjusted selling price method, wherein we use the profit margin. Okay, adjusted selling price method. This is the method which is being used here. Okay, done. Now we have a sales of 52 lakh 20,000. Okay, in this, out of this 52 lakh 20,000, the stock has been written off for this one. Sure. The value which has been written off is, we have a sales of 52 lakh 20,000. Okay, this includes the sale of this one lakh 20,000, which includes this 1,60,000. So we'll have to minus this first. So this sales 52 lakh 20,000. This includes this includes 1,60,000. So you'll have to minus this 1,60,000. Okay. Then you need to see the profit margin. That is 25%. We'll do it here. So basically, sales is given. That is nothing but 52 lakh, 52.2 lakh. Okay. In that, you will have to minus this abnormal sales. Sold for 1,60,000. You have to minus that. 1.6 lakh. You'll have to minus 1.6 lakh. You'll be getting around 50.4 lakhs. No, 50.6 lakh. 50.6. 21 times. So you're getting 50.6 lakh. Okay. So you'll be getting, this is the actual sales which is happening. Okay. In this, we need to find 25% on cost. This we have sales value. That is nothing but into 25% cost is nothing but 20% on sales into 20%. That is nothing but 20 by 100. That we'll be getting an answer of 1 second. Okay, we'll be getting an answer of 10 lakh 12,000. 10 lakh 12,000. Okay. This 10 lakh 12,000 is nothing but the gross profit. Okay, for the stock, for this particular stock after minusing the abnormal sales. But in abnormal sales also we have a profit of 20k. No, in abnormal sales also we have a profit of 20k. That also to be added. No, this is a gross profit margin for the normal sales. Okay, for abnormal sales we are minus 10. That profit also we have to add 20k. So totally we'll be getting a profit of 10 lakh 32,000. 10 lakh 32,000. So basically from 52 lakh 20,000 we'll have to minus 10 lakh 32,000. Then we'll be getting a figure of this total will be getting as 48 lakh 60,000. Here we'll be getting it as 41 lakh 88,000. Okay. When you minus this, we'll be getting a value of 6 lakh 72,000. This is the value of closing stock. Here the main adjustment is two things. One is abnormal sales. Abnormal sales you have to minus. I'll go back to the theory. We'll just read that now. Maybe you'll be able to understand it now. See, the percentage used takes into consideration that the percentage means the margin used takes into consideration inventory which has been marked below its original selling price, which is nothing but abnormal sales. We have to minus that. Okay, it takes into consideration the inventory which has been marked below its original selling price. Okay, that we have taken into consideration. I hope this is clear. This is the main adjustment which you need to remember. You have to minus, then take the value, then also add the profit or loss, whatever is there, you add that, and then you reduce it from the sales value. Okay, I hope this is clear. We'll move on to the next question. Example number 2. Here, physical verification of stock in a business was done on 23rd June. Oh, it is done on 23rd June. The value of stock was 48 lakh. The foreign transaction took place between 23rd June and 30th June. So we need as on 30th June basically. We need stock as on 30th June, but stock is given on 23rd June. That is nothing but 48 lakhs. So we need to add purchase, sales, all that plus minus revenue. Okay. Out of the goods sent on consignment, goods at cost worth 2,40,000 were unsold. So which has been lying with the third party. Which has been lying with the third party. So what do you do this? We already saw no, which our stock which is lying with other people. So that we'll take into consideration. That is add 2,40,000. So I'll just take it like this. There should be addition of few items. There should be subtraction of few items. That is goods sent on consignment. Goods at cost were unsold, which means you need to add this. That is a number 2.4 lakhs. Then purchase of 4 lakh were made, out of which goods worth 1,60,000 were delivered on 5th July. So basically, purchase of 4 lakh were made. Okay, out of which we goods were delivered on 5th July. So two things here, two things to be considered here. What is happening here? First thing is that we have made a purchase. We have made a purchase of 4 lakh. Okay. In out of this 4 lakh, to be bifurcated into two. One is 1,60,000. Were delivered on 5th of July. Were delivered on 5th of July. The remaining 2,40,000 has been delivered within the date. Okay, this has happened. The transaction is given, which has happened between 23rd June and 30th June. When you're purchasing, this to be added in your inventory. No, this is to be added in inventory. That is nothing but 2.4 lakh. Add that. Purchase. Okay. Then again, this 1.6 lakh, this goods in transit. Add that also. Goods in transit 1.6 lakh, which are not received, but still we need to add this. Which is received on 5th of July. As on 30th June, you're not received, but goods in transit, you'll say goods in transit and add this also. Okay. Done. Then sales were 13,60,000, which includes goods worth 3,20,000 sent on approval basis. Half of the goods were returned before 30th June. So basically, in this sales we have made, sales is nothing but 13.6 lakh. Then this includes 3.2 lakhs, which is sent on approval. In 3.2 lakhs, we have two bifurcation. Half has been returned. Okay, that is 1.6 lakh, 1.6 lakh. In this half to be considered as sales. Remaining half not to be considered as sales because it's returned before 30th. So what is the total sales then? 13.6 lakh minus 1.6 lakh. That will be 13.6 lakh minus 1.6 lakh because it's written by the customer. So total will be 12 lakhs. 12 lakhs is the actual sales. In that 12 lakhs, goods are sold at a cost plus 25%. Cost plus 25 means 1/4 of the cost will be 1/5 on sales. 1/5 on sales. That will be nothing but 12 lakh into 20%. 20%. 12 lakh into 20%. That will be 2,40,000. That will be 2,40,000. Okay. Huh. But here, also one more thing also we need to mind is here. What is that? Before finding this, the actual sales is 12 lakh. But here we can also notice that goods are sold at cost plus 25%. However, goods costing 2,40,000 has been sold for 1,20,000. So this includes 1,20,000. This 12 lakh sales include 1,20,000. You have to minus that also. 1.2 lakhs. Abnormal sales. Abnormal sales. So it will be 10.8 lakh. It will be 10.8 lakh. Okay. But our loss is 2,40,000 minus 1,20,000. Loss is 1.2 lakhs. This is the loss which has been incurred. We'll have to minus from the margin whatever we're getting here. Okay. So basically here what happens? So 10.8 lakh we have. In 10.8 lakh, we need to find the gross profit. That is 20%. 20%. That's nothing but 2,16,000. In that minus that loss, whatever we're getting, minus 1,20,000. You'll be getting 96,000. You'll be getting 96,000. Okay. So now in the sales, actual sales we have is That is nothing but 12 lakh. 12 lakh is the actual total sales, including abnormal everything. Okay. 12 lakhs minus the margin. That is 96,000. Minus the margin. 96,000. That is nothing but we have taken all items into consideration. Uh, and also here, one item which we need to take into consideration is the one item which we need to take into consideration is the cost of goods sold, which was sent on approval basis. So basically here, goods which was sent on approval basis, what is happening here is the goods, which includes goods for 3 lakh 20 sent on approval basis. Half of these were returned before 30th June. Okay. Half of this were returned before 30th June. So what happens here is 1 lakh 60 has been returned back. Okay. But this is at a sale price. 1 lakh 60 has been returned back, which is this is at a sale price. So what is the cost price of this? We need to take it at cost. Okay. We need to take it at cost. If it's returned, we need to add. No, we need to add. The goods haven't returned back for us. So we need to add this. So 1,60,000 is the selling price. Okay. What is the cost of this? How do we find? How do we minus the profit on this? 1.6 lakh into 20%. 20% is the cost. No. 20% minus 20%. Okay. You'll be getting the value of 1,28,000. Okay. So we need to take the total. Total will be getting up to 7,68,000. And here also we'll be getting to 1,50,000. So total will be getting a value of 44,64,000. This is the value of closing stock. Here mainly three adjustments. One is the closing stock is given as on 23/6. So we need to find closing stock as of 31st March. Okay. So in that we are adding and reducing few items, but the main adjustment here is the with respect to sales. Sales what happened? Here are two adjustments. One is we have a goods returned back, which is sent on approval. And also we have abnormal sales. Those two adjustments to be taken into consideration. Okay. That to be taken into consideration. So that is one. First is the 1,20,000, second is the 96,000. Those two effects in India, you'll be getting the results. Okay. I hope this topic is clear for you guys. Okay. Thank you. Thank you all. Hello, students. So in the revision series, this is the third topic. That is nothing but depreciation and amortization. This is a very easy topic only, nothing much to worry about. So we'll just go through the points with some of the important points. Okay. Now, first step, we'll come into introduction. Introduction to depreciation and amortization. We'll look at the general meaning. What is the meaning of depreciation? Depreciation, nothing but reduction in the value of fixed asset. Reduction in the value of fixed asset due to physical wear and tear. Okay. Say for example, the fixed value is 10 lakh. So every year we'll be depreciating it by say 10%, which will be 1 lakh. Okay. Balance will be 9 lakh. So this is a reduction value of fixed asset due to physical wear and tear. Specific meaning is allocation of capital expenditure over the useful life of the asset. Over the useful life of the asset, we'll be allocating some expenditure to P&L. That is the allocation of towards the useful life of an asset. Okay. So when it comes to tangible asset which can be felt, touched, okay, like plant and machinery, computer, all of that are tangible assets. When coming to intangible assets, nothing but the trademark, patent, copyrights, computer software, all of these are intangible assets. For tangible assets, we use the term depreciation. Okay. For intangible assets, we use the term amortization. So this is the difference between depreciation and amortization. Otherwise, the treatment is the same. Done. What are the reasons for depreciation? One is the wear and tear. We saw that they use in a business, there'll be wear and tear. That is one reason. Then effects of time. Through the usage of time, when the time passes by, even the assets, the value of the asset will be depreciating. Okay. Then obsolescence due to technologies. This means due to advance in the technologies, the value of the asset which we have that will be reduced. Okay. And decrease in the market value. This is also one of the reasons for the for charging depreciation. Okay. Then coming to the definition of asset. This is very important, which you need to remember. Okay. Not from the exam point of view, but As a knowledge, you need to remember this. Okay. Property, plant, and equipment are tangible items. Property, plant, and equipment are tangible items. So here, asset definition. No, here they use the word property, plant, and equipment. This is also known as fixed assets. It's also known as fixed assets. Okay. Property, plant, and equipment. Assets or fixed assets or property, plant, and equipment. Uh, this property, plant, and equipment are tangible items that are held for the use in production or supply of goods or services, which is held for use in production or supply of goods or services, for rental to others, or for administrative purposes. Okay. And are expected to be used during a period more than 12 months. This is very important. If it's used for a more period of more than 12 months, then you can classify this as an asset. Okay. So basically, it should be held for the use in production. Say, for example, manufacturing of any product, if you're using a plant and machinery, that those things can be classified as an asset. Then, cost of property, plant, and equipment. What is the cost of an asset? What is the cost of an asset? Property, plant, and equipment. First thing is its purchase price. Whatever your price you're paying in order to purchase that to be included. Okay. Including any non-refundable import duties. If any duty which is non-refundable, then you'll be including those things also. Okay. Say, for example, in this case, um, if you're buying a property, no, in that case, it will be stamp duty. Stamp duty will be added to the bill of goods. Okay. And purchase tax after deducting trade discount. Trade discount immediately to be reduced. Okay. And rebates. Any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the enterprise. Say, for example, if you're buying a plant in Mr. In your office premises, you need to clear out some space, or you need to build a shed for that. So all of that to bring the asset to the location and the condition necessary for it to be capable of operating. So all that whatever you make, no, all that can be added to the cost of the flat property plant. The initial estimate of the cost, dismantling, removing, all that, installation charges, if any other asset is dismantling that, removing that, clearing the space, all that to be added. Okay, all of these will be added to the cost of an asset. This is also very important. Okay. Examples of directly attributable cost. What are the examples of directly attributable cost? Cost of employee benefits arising directly from acquisition of construction of an item of property plant. If any person is supervising specifically only into construction or acquisition of that particular item, then that cost can be added. Then coming to cost of site preparation. The site preparation cost, okay. Initial delivery and handling cost, fine. Installation and assembly cost, fine. Cost of testing whether the asset is functional. If at all, that automated machines will be there, no, huge machines which will automatically prepare the items such as say bottles, all the cans, bottles, all of that automatically one will be prepared. In that case, cost of testing whether the asset is functioning properly. Okay, those things will be directly attributable to cost. But if you're getting any after deducting the net proceeds from the selling the items, if there is also if you're getting any revenue out of it, okay, from that samples which have been generated, that has to be minused. Okay, professional fees. If you're taking any consultation or professional help for the installation of the machine or for the ideas design or anything, that also can be added to the cost of the machine. Okay, done. We'll move on to the next topic. See, basically all the expenses which are necessary for the asset to bring in the condition and location, basically put to use. You have to remember the word put to use. Okay. Here you need to remember the word put to use and ready to use. Ready to use. Okay. Sure. Sure. In this case, no, whatever cost which has been incurred, okay, in accounting, whatever cost which has been incurred for the asset to be ready for use, this to be considered. Okay, till the asset is ready for use. In income tax, we use this. So for your syllabus, it's on there. I'm just telling you. No, so put to use, we use in income tax purposes. But in accounts, we always use the word ready to use. Till the asset is ready to use, whatever cost is being incurred, that all the cost to be capitalized. However, the following expense should not form part of the asset. What are the costs that should not form part of the asset? Cost of Opening new facility or business, such inauguration cost, all that won't be incurred because until the asset is ready for use, we need to capitalize it. Cost of introducing new product or service, advertisement, promotion, and all not to be included. Cost of conducting business in new location with a new class of customers. Cost of staff training, all that to be not to be included. Okay. Administration, this is always not to be included. Administration and other general overhead costs. Done. Once the asset has been brought to the intended condition and location of use, no cost should be recognized as part of the cost. Once the asset is ready, after that, whatever cost has been incurred, that not to be added to the cost of an asset. Okay. Only if anything, only if the cost which is incurred to increase the capacity, working capacity of the machine, only those costs to be added. Other than that, whatever cost is incurred, that will be charged directly to profit and loss account. Okay. Only if you remember the word capacity. If it's increasing the capacity, working capacity of the machine, only then to be capitalized. All other time, you need to transfer to payment. Um, then we have various methods of charging depreciation. Okay, we'll discuss that one by one. One such method is you have commonly heard this method. It is nothing but straight line method. Is also known as original cost method, also known as fixed installment method. Okay. Here, what happens basically, you have a original cost value, that is a purchase cost we have. Purchase cost, say for example, 10 lakh we have. So in the straight line method, uh, what do we do here is, say for example, 10 lakh we have. Here also we have a scrap value, that is 2 lakhs. So we minus 2 lakhs, that will be giving us 8 lakhs. So take this 8 lakhs. With this 8 lakhs, whatever the useful life, say for example, the useful life of an asset is 8 years. So divided by 8. So 1 lakh will be charging per year depreciation. So always here, the depreciation amount will remain same. The depreciation amount will remain same in all the years. So 1 year, 1 lakh, 1 lakh, 1 lakh, in first year, second year, third year, fourth year, all the years, the depreciation amount will remain the same. Okay. So that's why it's called fixed installment method or straight line method or original cost method. Okay. Now going on to the next method. Next method is nothing but reducing balance method. Reducing balance method or written down value method or diminishing balance method. This is commonly known as written down value WDV method. Okay. Under this method, what happens? The depreciation figure changes every year. Say, for example, 10% is a depreciation. So 10 lakh is the value of an asset. So first year, if you minus 10%, that will be 1 lakh. So your balance will have 9 lakh. Again, if you minus 10%, that will be 90K. Okay. The balance will be 8.1 lakh. So what happens here? Every year, the depreciation changes. The depreciation value changes. Under this method, the amount of depreciation goes on reducing, basically reducing. First year we charged 1 lakh, second year 90,000. So reducing every year as the depreciation is calculated on the WDB of an asset. Okay, it's not calculated on the original cost. This method is more practical as compared to SLM because under this method, the asset account never becomes nil. The asset will continue to appear in the books till the time asset is physically existing. See, basically this method is used wherein the technology of an asset matters so that they can charge higher depreciation in the initial years. Then after the first year, after a few years, they'll be reducing the value of an asset. Okay, the depreciation value also reduces. Now, under this method, the overall change on profit and loss account because of use of asset remains more or less constant as the amount of depreciation under this method reduces year after year, and against this maintenance expenditure increases every year. Okay, income tax will prescribe this method. Yes, in income tax we use this method only. Yeah. Under this method, if the rate of depreciation is not given, then it will be calculated as follows. The formula for this rate of depreciation is equal to 1 minus 10 to the power residual value by cost of the asset income. Okay. But usually the depreciation percentage will be given so that you can calculate that. If not, you can use this formula. Done. Then depletion method. What is this depletion method? Normally, this method of charging depreciation is used in case of self-extracting assets, like wasting assets. Okay, basically in case of mines, coal mines, oil fields, okay, all such places, they use depletion method. What this depletion means? Here, normally the cost of such asset depends upon the total output which is expected to be extracted. Say, for example, you want to extract 100 tons. Okay. So each whatever, how much ever you've been extracting. Okay. Based on that, the depreciation is calculated. Okay. How we just read this. Normally, the cost of such asset depends upon the total output which is expected to be extracted from the asset over its useful life. Hence, the depreciation on these assets will also depend upon the output actually extracted year after year. Okay, so basically, the formula is annual depreciation income plus original cost of the mine minus estimated scrap value divided by total output estimated from the mine into actual output extracted in the year. Actual output extracted in the year. Say, for example, 100 tons. So total output estimated is 100 tons. Okay, total output estimated as 100 tons. So this original cost of the mine, say for example, it is some 50 crores UK, 50 crores. Okay. So here, whatever is extracted during the year, actual. Say for example, out of 100, you have extracted 10 tons, right? So every year, whatever is actually extracted, you will be calculating based on that. Okay. Asset value, or original cost of the mine, that is 50 crore into actual output. That is whatever you've extracted, 10 tons. Okay. Then total output estimated, that is 100 tons. We'll be calculating this method. Then machine hour method. Machine hour method and production unit methods are more or less similar. So here the depreciation is calculated based on the machine hour basis. Here or based on the units produced. Okay. So basically the formula is original same formula, actual production by total number of hours used in life. Here also actual production divided by total production estimates in units. Okay. Now move on to the next topic. Sum of years digits method. Okay. Sum of year digits method. This method is developed to combine advantages of SLM and reduced balance method, both. Okay, under this method, the amount of depreciation will vary every year and still the assets will become zero at the end of its useful life. So here, what is this reduced balance method? Say, for example, the depreciation to be calculated is for 10 years. Okay, depreciation to be calculated for is 10 years. Okay, here we take sum of the digits, sum of the years digits. That is nothing but 10 plus, 9 plus, 8 plus, 7 plus. If you take all till 1, if you take, you'll be getting 55. So first year will be taking the cost of the machine, that is 100 rupees into 10 by 55. Second year, 100 into 9 by 55. Okay, in this way, original cost of the machine minus estimated scrap value divided by sum of the digits of number of years in useful life. That is nothing but 55 into years left, including current year. That is, first year is 10 years are there, second year 9. This automatically keeps reducing. Okay, this is basically the sum of years digit method. Now, then we'll see the accounting for the depreciation. Okay. See, basically, generally, how do you account for depreciation? Depreciation account debit. Depreciation account debit to fixed asset. Whatever asset it might be, fixed asset account will be posted. Okay. So, whenever you have a provision for depreciation account, that is accumulated depreciation. Provision for depreciation, or it's also called as accumulated depreciation. Accumulated depreciation. Okay. In this case, how do you account? Same, similar. Instead of posting it to an asset account, you'll be posting it to accumulated depreciation account. So basically, the entry will be depreciation account debit to provision for depreciation account. Instead of a fixed asset, you'll be posting it to provision for depreciation account. Okay. So what happens in this method? If you follow this method, the cost of an asset in the balance sheet, the cost of an asset in the balance sheet will be shown at the original cost itself. Will be shown at the original cost itself. Okay. And the depreciation, what happens to depreciation? This will also be getting accumulated. This will also be getting accumulated. But this will be also will be shown at original cost. Total depreciation will be shown at that also total depreciation will be shown as provision for depreciation or accumulated depreciation at total value. Okay. Then note, there's also note given work WDV on any particular date can be determined by reducing provision for depreciation from original cost. Okay. Then coming to there is another method. There is another method when there is a disposal. Okay. Preparation of asset disposal account. If at all, see, whenever you sell an asset, what happens? The entry will be cash or bank account debit you're receiving cash over to fixed asset account. Instead, you're selling, so it's reducing. We'll be crediting that. Okay. So generally, this is what will happen. Okay. So whenever you're selling an asset, when you're maintaining a asset disposal account, when you have a disposal account, this entry is when you don't have a disposal account. When you have a disposal account, what will happen at that time? So that time the entry will be cash or bank account debit to asset disposal account. The separate account will be open. Okay. This disposal account, okay, this disposal account then is transferred to asset account. Then is transferred to asset account. So why this is done? So basically, some of the companies, they follow this asset disposal accounts. They'll be having a lot of uh, assets will be sold on a regular basis, because what happens is they'll be purchasing in a huge MNC and all, they'll be purchasing a lot of laptops and other items. Okay. So there'll be a lot of employees working. So they'll have, say, for example, 10,000 employees in their organization. In that case, what happens is the laptop, whichever they purchase, no, they'll have a 3 years useful life for the laptops. So after 3 years, they have to sell the laptop, right? So every year on here, they'll have some other sales because they would have purchased it 3 years back. Correct. Now, after 3 years, they have disposed the asset. So that is when they'll be having asset disposal account. In that account, they'll be transferring whatever the proceeds they've been receiving. Then after that, they'll be transferring that balance to transfer original cost of the asset to the asset disposal account. Then that will be transferred to the asset value, whatever is there, be transferred to the disposal account. Then on that, whatever the profit or loss is there, then it should be identified. Okay. Then after that also you need to transfer the depreciation amount. Whatever the depreciation is there, that also be transferred. Then we'll be getting on the profit on sales. Okay. Then transfer accumulated depreciation on assets sold to the asset disposal. So for the provision for depreciation will have a credit balance. So transfer that, whatever relating to that particular asset, debited in credit asset disposal account. Then the net balance in asset disposal account at the end of the year represents net profit or loss. Okay. Then it shows the net profit or loss. It shows. Okay. Done. Next coming to other important concepts. What are those? One is the change in method of depreciation. Say, for example, the entity is following SNM for the initial 2 years. Okay. Then they want to change it to WDV. Let them change for the remaining 8 years. It's fine. Let them change. So what happens? So for example, 10 lakhs is that 2 lakhs if you're doing under SLM basis, 2 lakhs will be reducing. Remaining balance will have 8 lakhs. So on 8 lakhs, start charging WDV method. Okay. So on remaining 8 lakhs, start charging WDV method. That percentage will be given. Based on the percentage, you'll keep charging that. Okay. Now, and one thing to be noted is this to be done prospectively. Prospectively to be done, not retrospectively. So from this balance, you need to go forward. Prospectively, this need to be done. Okay. Yeah, here it is. Prospectively to be done. Then one more thing is revision of estimated useful life of property, plant, and equipment. Immediately they were told the asset can be used for 10 years. Okay, now what happens after usage of 2 years? We got to know that the asset can be used only 5 years. So initially, for 10 lakhs, we were dividing it by 10. So 1 lakh was the depreciation. After usage, after usage of say 5 years, after usage of not 5 years, after usage of 2 years, okay, balance is 8 lakh. 8 lakh to be divided by 5. Okay. This is change in estimated useful life of an input. This basically known as change in estimate. This is change in policy. Change in method is nothing but policy. Change in useful life is nothing but estimate. Okay. Done. Then another important topic. Revaluation of property, plant and equipment. Revaluation of property, plant and equipment. Say there are two cases here. Asset can be valued upward or it can be valued downward. Asset can be valued upward or downward. Say, for example, you purchase an asset for 10 lakhs. Either it can be valued to 12 lakhs or even more, or it higher basically, increase. Either it can be valued at 5 lakhs, basically decrease. Okay, those two cases are there. In that, we have another two different types. We'll just directly look into the diagram here, which is given here. Revaluation account. So basically, when you do revaluation, there is upward revaluation, there is an increase. Then there is downward revaluation, that is decrease. Okay. If at all there is an upward revaluation, upward revaluation, that is the increase in the value of an asset. If there is increase in the value of an asset. So what you will do that time? So that whatever the difference, whatever the increase is there, that will be credited to the revaluation reserve account. So basically debit FA and credit to revaluation reserve account. Okay, this is what happens. Then there's another category here, which is the subsequent increase. So initially it was decreased. Initially it was decreased. Now again it's increasing. So what happens that time? Whatever decrease is there, whatever decrease it had faced, okay, that to be okay. One second. We'll just discuss the downward, then we'll come to this. Okay. So we discussed this. Then, if at all there is any downward revaluation, if at all there is any downward revaluation, what to be done? That time you need to charge it to P&L account. If at all there is any downward revaluation, charge it to P&L. If at all there is any upward revaluation, charge it to credit it to revaluation reserve account. Okay. Now this is the just upward or downward. Now subsequent we'll see. Subsequent. Okay. Now in subsequent, what happens? So when there is subsequent increase, this one subsequent increase is that initially it decreased. Okay. Say for example, initially it was decreased for 2 lakhs. Then subsequently it's increased for 3 lakhs. Okay. What happens that time? So this 3 lakhs, we are talking about only 3 lakhs now. Initially when it was decreased, you would have charged it to P&L account. Now subsequently it's increased. That time what happened? This 2 lakhs to be charged to P&L account. The remaining 1 lakh will be credited to revaluation reserve account. Okay, this is the accounting treatment. So whatever the increase of 3 lakh is there, this is for subsequent increase. You need to take it into 2 categories. 2 lakh will be charged to P&L because initially it was a decrease, so that is why. Then the remaining balance, what is it? That should be charged. That should be credited to revaluation reserve account. Okay, similar case. If we have another case here, similar. When we have a when there is a downward revaluation and subsequent decrease. Subsequent decrease means initially it was increased. Say initially it was increased for 2 lakhs. Then subsequently it was decreased for 3 lakhs. What will happen at time? So this also divided into 2 categories. Initially, you have debited when it's increased, you would have credited to evaluation reserve account. So when it's decreasing, that 2 lakhs debited to revaluation reserve account. Remaining 1 lakh is there, right? That you take it to profit and loss account. Take it to profit and loss account. Same thing is given. First thing, subsequent increase, credited first to the profit and loss account to the extent debited earlier due to decrease in value. Then subsequent decrease initially increases, debited to revaluation reserve account to the extent created earlier due to the increase in value. Okay. Then I hope this is clear. Then there are some basic points which you need to remember. Depreciation is the process of allocating the cost of an asset to the estimated useful life of an asset. Depreciation is charged from the date when the asset is available for use, which means it is ready to use, ready for use. Okay. Objective of providing depreciation is to find the correct P&L, provide funds for replacement. Okay. Depreciation is charged against profit and not appropriation. It's a charge against profit. Okay. It is not a depreciation. It is not a depletion of management. It has to be done. Okay. That's what it says. Causes of depreciation are physical and passage of time, obsolescence due to technology. That was okay. And depreciation is charged on fixed asset. Fixed asset is asset held for the purpose of production. All that we already discussed. Like, there's just a summary of that. In case of companies, depreciation is provided as per Schedule 2 of the Companies Act. Okay. Depreciation on intangible asset is called amortization. Depreciation is a non-cash expenditure. Calculation of depreciation are based on 3 factors. Calculation of depreciation is based on 3 factors. What are those 3 factors? One is cost of an asset. We should know the cost of an asset. Cost of asset we already discussed. Then we should know estimated useful life. Okay. Then we have to know residual value. Based on these 3, we can calculate the depreciation. Okay. Fine. We'll there's one example question. We'll solve this question so that we're clear with the topic. The LG Transport Company purchased 10 trucks at 45 lakhs. Purchased 10 trucks at 45 lakhs. Okay, each 45 lakh each. Okay, so that which means 4.5 crores. Okay, each on 1st April 2019. On 1st October 2021, One of the trucks is involved in an accident and is completely destroyed, and 27 lakh is received from the insurance in full settlement. On the same date, another truck is purchased by the company for the sum of 15 lakhs. The company writes off 20% of the original cost. This is the depreciation rate on the original cost. Okay, per annum. The company observes the calendar year as its financial year. Calendar year as its financial year. Okay. Which means 31st December will be the year ending. Give the motor truck account for 2 years ending 31st December. 2 years ending 31st December 2022. Only for 2 years they're asking to prepare this motor truck account. Okay. Which means we have to prepare for 2021 and 2022. 2 years. But this was purchased on 2019. So we need to do some working notes. Okay. So basically it was purchased for the value of 45 lakhs into 10. That will be, instead of that, we'll do one by one. It is purchased for the value of 45 lakhs. Okay. It is purchased for the value of 45 lakhs. So the depreciation, how much it is purchased now? 1st of April. So for 9 months, depreciation to be calculated for 9 months. That is nothing but into 20%. 45 lakh into 20% into 9 by 12. Okay. We'll be getting a value of 6,75,000. Minus that, we'll be getting 38 lakh 25,000. Okay. Then again for next year depreciation, 2 years we need to do because account we need to show for 2021 and 2022. Okay. So next again, this is for the original cost method. Okay, 45 lakhs into which we did now for 2019. Now it is for 2020 into 20% into 12 full 12 by 12. Full year we need to go out. Okay. So that will be coming up to 9 lakhs. The value is 29 lakhs 25,000. Okay. Then again for the depreciation for we need to provide again depreciation. From here we have to start the account. Okay. We anyway can set the depreciation here so that we can take it to the account easily. Done. So basically next again for 2021. For 2021 we need to calculate depreciation. That will be nothing but 45 lakhs into 20% into here, only till here. That is on October 1st, 2021, one of the trucks involved in an accident and is completely destroyed. So one of the truck was involved in an accident and was completely destroyed. Okay. So we'll find for 9 months so that whatever the balance is there, we'll be able to find it in an account. Okay. 9 by 1, we'll be getting a depreciation of 6,75,000. The balance will be 22,50,000. Okay, 22,50,000. This is for one asset we've calculated. Similarly, into 10 if we'll be calculating for all the assets. But since we have calculated this for one asset, this asset has been sold for 27 lakh. 27 lakh. So the difference will be 4.5 lakh. So it is sold for a profit. Asset value is 22,50,000. We have sold for 27 lakh. So profit we have of 4.5 lakh. Done. So now we'll be preparing the account. Notice. They're asking motor button. We'll be preparing motor button. Motor truck account. So basically, we need balance for 2021. This is 2019, 2020. This is for 2021. This balance 29 lakh 25,000. So 29 lakh 25,000. This is for one asset. So we do 10-year period basically. So 2 crore 92 lakhs 50,000. That will be for 10 assets. Okay. So this is the value of an asset. This is the value of an asset. That's not about opening balance. This is the opening balance. So from this opening balance, what is happening during the year transactions? So one asset, one of the trucks is involved in an accident. One of the asset is involved in an accident and destroyed, and 27 lakh was received. 27 lakh was received. So if you're receiving 27 lakh for a particular asset, we have to record the same, right? So record 27 lakh. Saving bank by bank. Okay. After this, we have received 27 lakh. So similarly, the profit also to be recorded. No profit. So it should be recorded at the net value, right? So profit also we should be recording. So profit that should be nothing but 4.5 lakhs. Okay, we have recorded the profit. We have also recorded the sale value also. Okay, sale value is insurance claim value. On the same day, another truck was purchased by the company for sum of 50 lakh. So one truck was purchased for 50 lakhs. So 50 lakhs. The truck has been purchased. Okay. So now we need to provide for depreciation. So nothing else is there. So we need to provide for the depreciation. So depreciation, how do we provide? Depreciation is nothing but we have to provide depreciation in two different cases. So one is that depreciation we have to provide for 6,75,000 is there. 6,75,000 is the depreciation which we have provided. This is for 9 months for all the 10 months. So this depreciation to be accounted. So this depreciation will be accounted first. So total depreciation for the unit will be 6,75,000. So this 6,75,000 that is for this particular asset. That is book depreciation 6,75,000. Now this is for that particular asset. Then we have to provide depreciation for all of the assets. All of the assets that is nothing but 6,75,000 into 10. That is nothing but 67,50,000 plus to this you need to add the asset value here is 22 lakh. We'll do this way. Here the after the this only for one asset with cashier depreciation. Then we have the asset balance as 22,50,000. Okay. This is for one asset. For 10 assets, for here we need to calculate for 9 assets. Into 9 you have to do. So into 9 you have to do. You will be getting a value of. You will be getting one value. Okay. So basically 22,50,000 into 9. On this you will have to add plus 50,000. 50 lakhs. This new asset which you purchased. 50 lakh. On this value, whatever you're getting, on this we need to calculate a depreciation of 20% into 3 by 12. Because for 9 months already calculated. For 9 months already calculated. Now we need to find for 3 months. We'll be getting a value of 83 lakh 50,000. 83 lakh 50,000 depreciation. Okay. After this, we will be getting a closing balance of 2 lakh 29,000. 2 lakh 75,000. This balance will be taken to the next step. Then on this value, the depreciation will be provided. This for 2021. For 2022, we need to provide. On this value, the depreciation, usually 20% will be provided. Depreciation value will be 91 lakhs. Okay. So this is the calculation to be done. This is an easy topic only. You'll be getting a 5 to 10 mark question from this topic. So it's easy, you can score this. Okay, I hope this is clear. Thank you. Hello, people. In the revision video series, today's topic will be bills of exchange and promissory note. Again, this is an easy topic only. 5 to 10 marks can be expected from an exam point of view. So we'll see the important things what is there in the topic. Okay. Firstly, the introduction. The bills of exchange. No, it is an definition saying it is an instrument in writing. It is an instrument in writing with an unconditional order. That's very important. Okay. It should be unconditional. It should not be based on any conditions. When an unconditional order is given by a person called drawer to a person called drawee to pay a certain sum to a certain person on a certain date. Okay, we'll understand who's drawer and drawee. Okay. But remember that it should be an unconditional order. It is bills of exchange. What are the features? It must be in writing. Okay, it should have an unconditional order. Amount must be certain. It must be dated. Okay, amount whatever the amount has to be mentioned. Say for example 50K. Okay, it must be accepted by the lawyer. This is also important. It has to be accepted by the lawyer. If it is not accepted, then it is not valid. It should be standard. Okay, the terms. Coming to the terms, we have drawer, drawee, acceptor, payee. We have four terms which is commonly used in this topic. So, who is a drawer? Drawer is a person who draws the bill. Say, for example, A sold goods to B. A sold goods to B. A is giving goods so that B will give the amount, has to give the money. Okay. So what happens? A, when he's selling the goods, A is giving goods to B and B is giving back the money. But instead of money here, what happens is A draws a bill on B. So A becomes a drawer. A draws a bill on B. So he is called drawer. Okay. So here what happens is he draws a bill on B and sends to B for acceptance. Sends to B for acceptance. Okay. So B is acceptor. Okay. B is an acceptor. He is also known as a drawee. He is an acceptor or a drawee. So here, when the bill is drawn, instead of money, bill instead of money, we record it as bills receivable in the books of A. In the books of A, instead of money, we record it as bills receivable. But same in the case of B, it will be bills payable. It will be bills payable. Okay. Here, we also have another term called payee. Payee is a person who's receiving the money. Okay. In this case, A is only receiving the money. So A can also be known as drawer or payee. But what happens is in certain cases, A will be endorsing this bill. Endorsing means transferring this bill to some other person. So someone else will be receiving the money. Say for example, C. Okay. In that case, C will be the payee. Okay. The drawer may not be a payee. He can be a payee, but not in all the cases. Okay. But the acceptor and the drawer are the same. I hope you understand and understood the terms. Okay. We'll move on to the next topic. Then coming to the accounting entries. Accounting, we'll look into the accounting entries one by one. Okay. In the books of the drawer, first we'll see in the books of the drawer. Okay. Then we'll come to the books of the drawee. Initially, how the transaction starts, entry for sales or purchase has to happen. Only when the sales or purchase is made, then this bills payable receivable will be accounted. So whenever you're making a sales, what happens is sales will be credited and drawee account. That is, say for example, A's account will be debited. Okay. Just an example. Just take it A. Okay. Entry for drawing and accepting the bill. Accepting the bill. So when you're receiving, when the drawee accepts the bill, you'll be receiving bills receivable, right? So bills receivable is debited. Credit, drawing. Here, drawing is credited. So instead of drawee's account, which is there, you'll be receiving a bills receivable account. Okay. And entry for the bills retained up to due date. When if your bills are being retained up to due date, no entry. No entry is recorded. Okay. There are two types of bills, at site and at date. Okay. So whenever the site is there, from the date of, it should be recorded from the date of acceptance. Okay. The due date has to be calculated from the date of acceptance. Always, in case of bill of exchange, there will be 3 additional days. 3 days grace to be given. Okay. Remember this. 3 days grace to be given. Okay. Done. Then entry for bill honored on due date. If the bill has been honored. So if the bill has been honored, bills receivable was already there in your books of accounts. Now when you're receiving it, cash account, you'll be receiving cash back. Bills receivable, which was earlier debited, now will be credited. Okay, which was earlier debited, now will be credited. Okay, done. Then if entry for bills dishonored on due date, if say for example, the bills have been dishonored. Bills have been dishonored. So initially, whenever you received a bill, what entry you would have passed? Bills receivable, account debit to drawee account. This is the entry which you would have passed. So if the bill is dishonored, the same entry to be reversed. If the bill is dishonored, the same entry to be reversed. Okay, that is nothing but drawee account debit to bills receivable account. So whenever the bill has been dishonored, there is something called as noting charges. There is something called as noting charges. What is this noting charges? Noting charges is we already discussed it in class. We just learned through it. Okay. Noting charges is nothing but a small expenditure which is incurred by the drawer in order to record the facts, why the reasons for not paying the same. Okay, we will be incurring certain expenses. This will be recovered from the drawing only. That is nothing but person A. Okay, recovered from him. So initially, we will be paying it. That will be received from drawing only. Okay, they are paid by the drawing initially and then recovered from the drawing. Done. Then entry for charging or providing interest. If any interest amount to be charged, we'll have to collect from drawing. Interest is your income, so credited. We should be recovering it from drawing. Okay. Entry for cash plus movement. So what happens in certain cases is, the time limit, that is whatever the time agreed upon, 3 months, 2 months, would have lapsed. Okay, that time the drawee will say that he wants to record a new bill. He wants to give a new bill. So there will be certain conditions wherein they have to pay cash. So we already discussed in class. No, that is nothing but they'll be paying certain amount in cash. Cash account debit, we'll be receiving the cash. New bill for issuance of new bill, bills receivable account debit to drawee's account. Drawee is supposed to pay, so drawee's account. Okay, done. Then for retirement of a bill. Retirement of a bill is nothing but paying. The drawee is paying us the amount. The acceptor. The acceptor is paying us the amount. That is nothing but cash account debit to bills receivable account. Bills receivable which is debited earlier, now it's credited. Since we're saying cash amount. If at all, if the bills is honored before the due date, there'll be a certain amount, certain like a discount kind, okay, which will be given. That is called as rebate. Okay, which will be given to the certain discount which will be given to the acceptor. Okay, that to be recorded. That's it is an expense for us. So that's why it's debit. It's like a discount. Okay. And next case is when the drawee is declared insolvent. When the drawee is declared insolvent. When it's declaring insolvent, whatever the bills receivable was there initially, we won't be receiving it. So we have to credit this. Initially it was debit, now credit this. Reverse. And debit the drawee. That is something but A. Entry for recovery. Now we have to recover the money. After it's declared insolvent, maybe 50% of his can be recovered. In that case, what do we do? We record 50% whatever we have received, 50% of how much we have received from bank, and remaining will be posted as bad debts. This also is an expense for us, that is why we get debited them. And parties account will be credited. That is A. Okay. Entries when the bills is discounted to the bank. There's another case wherein whenever you receive a bills receivable, you can get it discounted from the bank. Okay, we can discount it from the bank. Bank charges nominal charges, termed as discount. Bank will charge some amount and will pay you the money immediately and charge some amount. That is called a discount. So when the bank pays us the money, that is something like bank account debit, discount account debit to bills receivable account. Bills receivable is no more valid with us. So credited. Make it true. Okay. After when the bills is being discounted and if the bills is honored, the party is directly, the person A is paying to the bank. So in our books, no entry will be there. Because the party A is directly paying it to the bank. So in our books of accounts, no entry will be there. But if the same has been dishonored, okay, if the same has been dishonored, so what will happen here? So in that case, the drawee initially we would have credited him. Now we'll have to debit it because we have to receive it from him. Okay, we'll have to receive it from him. Drawee account debit to bank account. We'll have to pay this to the bank. This whatever the amount difference was there, which we'll be paying it to the bank. Okay, then later on we'll be collecting it from the drawee. Okay, this whatever we are collecting, this leads to the noting charges and also bill amount plus noting charges. Whenever dishonored is there, there'll be a noting charges as well. Okay, done. I hope you are understanding. No, it's not too fast, I guess, because we already discussed in class. Just a revision which we're doing now. Okay, entries when the bills is endorsed. Like I mentioned, when it is endorsed, transferred to some other person. Okay, what had happened that time? That time, in whoever it is whom you have to pay, initially his account will be credited. A vendor's account usually will have a credit balance. Say, for example, C will have a credit balance. So when you're paying him off, his account should be debited. Say, for example, endorsed is a C. So debit his account and bills his account credit. Again, when you're transferred and it is made honored, no entry. In your books, no entry because directly A will be paying to C. In your books, no entry will be there. When it is dishonored, that time again, whoever account we'll have to receive reverse the entries. We'll have to receive from the A's account and we'll have to pay to C. A's account debit to C's account. This is the entry. That is nothing but A is nothing but drawee and C is nothing but endorsing. A account, C account. Okay, these are the entries. Then coming to entries when bill is sent to bank for collection. Sometimes what happens, you also send the bill for collection, not to the bank. You also send the bill for collections to the bank. So that when you're sending it for collection, it is not getting it discounted. There's a different topic when you send the bills for collection. When you send it for collections, bill sent to collection, bill for collection, or bill sent to collection account debit to bills receivable account. Then this is the entry. When the same is honored, see again, this is not discounting. Okay, this is bill sent for collection. When it is honored in your books, you're receiving money. So bank is collecting on your behalf. So bank account debit, so bank will charge a commission for it. Bank charges account debit to bills for sent for collection. When the same has been dishonored, again, always drawings account will be debited when the bills is dishonored. And again, bills for collection has been debited, now it will be credited. Okay, has been credited. And whatever the charges are there to be paid in cash. Okay, I think this is clear. The similar entries are there for the drawee also. You can just go through this. Okay, there's nothing complicated here. We just run through the important points, then we'll wind up the topic. The important points to remember, that is the term of the bill. When the bill is drawn after date, the term of the bill begins from date of the bill. Okay. There's two things called after date and after sight. After date means from the date, after sight means from the date of acceptance, from the date of acceptance. When the bill is drawn at sight, at presentment or when no term is mentioned on the bill is paid whenever payment is demanded. When nothing is mentioned, when the bill is drawn at sight, at presentment, or when no term is mentioned. When no term is mentioned, whenever it is demanded, we'll have to pay. That is a similar case of check. Okay. Promissory notes. Promissory note is nothing but it is an instrument in writing containing unconditional promise. Unconditional promise signed by the maker to pay certain sum of amount to order of certain person. Indian currency is promissory. Currency is a promissory note. Okay. Here there's no waste days amount. Only in bills of exchange we have waste days. Feature. It must be in writing. It should contain unconditional promise not to be payable to bearer. It should be stamped. There are two parties, maker and payer. Maker and payer. Who is maker and payee? Sorry, maker and payee. Pay is who will save the money. Maker is who is giving it. Okay. Acceptance not required. Yes, because in bills of exchange case we need an acceptance. Here that same is not required. Promissory note is made by the debtor or the buyer. Okay. Noting charges. Noting charges, like I already mentioned, from the notary public. From a public official called notary public, this will be the facts of the dishonor will be recorded. Why is not paid at all? That fees is called noting charges. This is recoverable from a party who is responsible for dishonor. That is nothing but a drawee. From the drawee it will be recovered. That is nothing but in our case it was A. Okay. Renewal of the bill. So what happens next topic is renewal of the bill. Wherein what in certain cases the drawee will not be able to pay the amount within the due date. So he'll ask to renew the bill for the extended period. Okay, that is called renewal of a bill. Then we have retirements of bill. Retirement of bill of exchange means, like we discussed, if he is paying within the due date. If it is paying within the due date, then a certain amount known as rebate, that is a discount, will be given to him. Okay. Then coming to differences between bills of exchange and promissory notes. What is the difference? Next of it is an order to pay. It is an order to pay. It is a promise to pay. It is drawn by the creditor. It is drawn by the debtor. Number of parties, 3. That is drawer, acceptor, and payee. Here it is 2. Here there are 2 parties. That is nothing but payee and payee and maker. Maker and payee. We 2 parties are involved. Okay. Maker and payee. Drawer, payee, drawee and payee. He is also an acceptor. Here just maker and payee. Nothing but promiser or promisor. Acceptance required, here not required. Can be drawn payable to make. Can be drawn payable to maker himself. Yes, here no. Can be drawn without consideration. Yes, here it is no. Okay. This accommodation bill can be drawn without consideration. Yes. Why? Because this accommodation bill, what we discussed is in accommodation bill is nothing but there is no transaction, there is no purchase, or there is no sales, there is nothing. But still, two parties, that is nothing but A and B, come together so that they'll be wanting some money. So A will draw bill on B, and B will get a discount from the bank. Okay. There's no obligation to pay either for A or B, but still they raise a bill and get a discount from the bank. Okay. That is known as accommodation of bill. Now, what is the difference between trade bill and trade bills are equal bills of exchange and accommodation bill? Okay. It is drawn and accepted for some consideration, basically. When the purchase and sale is made for that consideration. This is drawn and accepted without any consideration. Just for without any consideration, it is accepted. There's no purchase or sales. Just since they want money, it has been accepted. It is drawn to settle a business transaction. Business transaction to settle that it has been drawn. Here to meet the financial requirements. Here it is drawn to meet the financial since they need money. This has been drawn. Legal status. The drawer can take legal action if the business is on. The drawer cannot take any legal action when the bill is because these two parties have come together and raised the bill. So there's no legal action which can be taken. Discounting charges. Discounting charges are borne by the drawer. Here, this is very important. You will see also questions with respect to this. Here, discounting charges are borne by the drawer. Okay, but here, in case the discounting charges are divided between two people, because both of them need money, they're taking this. So whatever ratio they're taking the money, that ratio, the discounting charges to be divided between two people. Say for example, 200 rupees bill is there, 200 rupees bill. In that, say 150 has been after discounting, you're getting 150. 50 rupees of discounting charges. Say for example, A and B are there. A and B are there. A and B are taking, A is taking 100, B is taking 50. So remaining 50 will be shared in the ratio of, this is 1 ratio, this is 2 ratio. 2 by 3. 2 by 3, that is nothing but 15, 33.33 will go to him, and 16.67 will go to 3. Okay. This is the important point. It should be divided between the drawer and table. Done. With some other important points, we'll just look into it. Bills discounted is a contingent liability. Bills discounted is a contingent liability in the books of the drawer and shown as a footnote to the balance sheet. Okay. If the drawee pays the amount, there's no liability for us. If the drawee does not pay, then it might be a liability for us. That is why, as of that date, it is just a contingent liability. Okay. When the bill is retained by the drawer, right? Drawer and payee are the same persons. Yes, you already discussed this. When bill is dishonored, noting charges are paid by the holder of the bill, but ultimately borne by the drawee of the bill. Yes, when the bills are dishonored, that noting charges. Noting charges, initially the drawer has to pay the noting charges in order to record the facts. But later, the same will be collected from the drawee. Okay. Discounted charges are calculated from the date of discounting to the due date of the bill. Okay, discount charges, whatever is there, they'll be calculated from the date of the due date of the bill, from the date of discounting to the due date of the bill. Okay, if the date of discounting not given, then calculate from the date of the bill itself. Rebate on the retirement is calculated from date of payment to the due date of the bill. Yes, you know this. Accommodation bill are drawn to raise finance, and from mutual fund. No consideration is necessary in case of accommodation bill. No consideration is necessary in case of accommodation of bill. There's no transaction which is happening there. When a transaction of bills receivable and payable are large, it is better to maintain bills receivable and bills payable. Both these books are subsidiary books. Okay. Both these books are subsidiary books. Individual entries posting is done from bills receivable book to credit side of debtors account, and total of bills receivable book is posted to the debit side of bills receivable. Okay. We'll get into this into detail in the chapter of sole proprietorship. Okay. Then individual entries posted is done from same vice versa. Bills of exchange is drawn by creditor on debtor. It is accepted by the debtor. Okay. Bills of exchange is also known as trade bill. Yes. Done. Okay. These are the points which you need to remember. It's better you just go through the transaction months. So if you solve one or two questions, you'll be able to understand. You can expect a question of 5 to 10 marks in an examination. It is an easy topic. I hope this topic is clear. Okay. Thank you.